consumers of money in their pocket, and we're going to have a super holiday season.
I do think we're far enough along that a lot of that scarring should begin to dissipate.
Even if the economy slows, rates stay low, inflation's going to moderate, and we're still going to get positive long-term equity returns.
We think any pullbacks or any pauses in the market could be short-lived and shallow.
Clearly, we're heading towards an environment where they have to consider tapering.
This is Bloomberg Surveillance with Tom Keene, Jonathan Ferro, and Lisa Abramowicz.
It's Payrolls Friday from New York City for our audience worldwide. Good morning, good morning. This is Bloomberg Surveillance alongside Tom Keene and Lisa Abramowicz. I'm Jonathan Ferro. Friday morning, equity futures up 2 points on the S&P, 31.12 after 6 straight days of gains on the S&P 500. Tom, your estimate this morning, 720K.
Lots of the series on the terminal are grinding in whatever direction, John. Grinding flatter yields, grinding this, grinding that. And yes, equity markets grinding up as well.
Yields lower, Tom. Down a basis point or two. 144 on 10s going into this. That curve now sub 120. 2s, 10s, 118.
First thing I looked at this morning, a 118.475 on the 2s, 10s spread. And with it, John, look at DXY. I mean, this is the major dollar index. Bloomberg dollar index, BBDXY, has caught up in the last 2 days. Stronger dollar.
Showing a bit of strength. Euro dollar down to 118.21. Here's the quote for me from the last 24 hours. It's on the labour market in America, and it came from the ISM, Lisa. Labour challenges across the entire value chain continue to be the major obstacle to increasing growth.
And the key question behind this is, how much does this have to do with enhanced unemployment benefits? How much does this have to do with the pandemic that continues to ravage certain areas? And how much does this have to do with childcare? Probably all of the above, but it's going to take time, John. And until we work out those kinks, these employment numbers are going to remain perhaps a little bit lower than people would like.
2 hours, 30 minutes away. Here's the price action going into that on the S&P 500. 6 days of gains coming into Friday. Can we make this 7? 43.13 on the S&P. We advance 0.06%. In the bond market, it catches your eye. Your 10-year now down to 144.24. And Tom pointed out the dollar strength. Lisa, dollar strength, euro dollar 118.22.
Reserve to hike rates, and that I think is what people are talking about, and the reason why the 10-year yield is as low as it is. At 8:30 a.m., we get a little bit of insight into the deliberations of the Federal Reserve, at least the data points they'll be considering. The U.S. payrolls number comes out, the June jobs report. This is one of 3 data points for the jobs market the Federal Reserve will be considering at their September meeting when they really decide whether or not to taper, or at least that's the expectation. The key thing that I'm looking for is momentum. How much momentum are you seeing beyond services, or is it just isolated to services? Do we get any kind of insight into how much the enhanced unemployment benefits have affected the willingness for some people to come back into the labor market? 10:15 a.m., look for the political spin. President Biden is speaking about the jobs report. Expect him to talk about the bigger unemployment benefits. Expect him to talk about the need for more infrastructure and more spending, the disparity, the 2-tier, the K-shaped recovery. And today, I find this actually really fascinating. OPEC Plus is continuing to negotiate output cuts after yesterday's meeting ended, frankly, in somewhat of a debacle. I mean, frankly, the United Arab Emirates coming out and saying that they wanted to have a bigger say in how they measure the output. And basically, if they don't come to an agreement, then the current output levels would be rolled over, which are a lot lower than people say would be needed to meet demand. Right now, you are seeing Brent and crude traded on the NYMEX a little bit lower, but earlier in the day, it was higher. And the question is how much further the prices could climb if they fail to reach an agreement, John.
75 handle on both WTI and Brent. WTI 75.16, Brent crude 75.75. We know all about fuel. We know about oil. We know about travel. It gets expensive, Tom, over the long weekend. It would be really expensive, wouldn't it, to get a plane right now and fly to, say, Greece?
It would be.
And take a long vacation.
Yeah, you know, and you've got to get quarantined for like 2 or 3 weeks. And, you know, it's very difficult. And, of course, all that we do here within her celebrity is try to keep it private. So there's like 200
Thanks,
islands,
Tom.
or they can't even count the islands, John. And I've been advised by one of her entourage it's not Crete.
It's not Crete.
It's not Crete.
We found out it's not Crete. Lisa
It's
is
not
going away.
Crete.
Lisa is going away this weekend and will be gone next
like
week.
within like 3 hours.
But it's not Crete.
I don't even think she
Right,
stays
guys.
for the last.
Can we confirm,
Thank
Lisa,
you.
it's not Crete?
It's not Crete.
It's
Thank you
not
so
Crete.
much for
Okay,
maintaining
thank
my
you.
privacy. We really appreciate that.
No, anytime. That's what we're here for.
Thanks.
Ronnie Crozier joins us now, University of Chicago Booth School Professor of Economics. Professor, good to catch up. Randy, 8:30 Eastern, 2 hours and about 25 minutes away. We'll get the payrolls report. What are you focused on?
I really want to look at the sectors, and I want to look at the labor force participation, and then also look at what's happening to wages. I think all three of those are going to tell us important pieces of what's going on in the labor market, and all three of those are going to feed into the Fed's thinking.
Professor Crozier, we're enjoying here the idea that one of our talents is going away to Greece to enjoy a sun-swept 7 days. And I want to get the lesson from you of the human condition. Greece was flat on its back, and nobody in Western economics has recovered like Greece. When we recover from this pandemic, do we underestimate the human condition just to recover here, where unemployment will go down to 3%, that we will see sustained GDP? Do we just underestimate the human oomph of coming out of a pandemic?
Well, I think psychology plays an enormous role in these things. I think I was less of a behavioral economist before I went to the Fed, but then during the global financial crisis, I became much more of a behavioral economist. My colleague Richard Thaler will really.
I was going to say, I'm going to cut in here, John. I know you want to pick this up. Thaler's rolling over now. Thaler's watching the Cubs go down in flames, and he's got Crozier badmouthing, Gary Becker's entire legacy, and that's outrageous, Crozier.
Wait a minute, I didn't badmouth it. I just said I'd become more of a behavioral economist. I didn't badmouth anyone.
John, pick it up here. I mean, Crozier's got me totally rattled going after the legacy of the great Gary Becker.
I think we should let Lisa do some work, Tom, before she goes away.
That's true.
That's so kind of you.
Did you see my tie today? For those of you on radio, I wore a lovely blue tie in honor of Greece.
Yeah, the Greece mention earlier, Tom, really tied in nicely to the U.S. jobs report. It wasn't gratuitous in any way. Professor Crozier, please save us and talk a little bit about the idea of transitory and the idea of good inflation and bad inflation. We're getting a sense that possibly oil prices could remain as high as they are, even head toward $100 a barrel. We're looking at food prices spiking higher to the highest levels by some measures since 2011 due to the drought out west in the United States. At what point does this become a disinflationary force? How much does this sort of factor into the Fed, even though this isn't part of the core PCE?
Sure, I think they're looking at what are exactly you said, what are transitory factors, what are long-term factors. And also the concern is, could enough transitory factors lead to a long-term change? And that would be through a change in inflation expectations. If you remember, people have been getting low wage increases and facing low prices for quite some time. That's now changing over the last few months, where we're seeing a significant spike up in consumer prices on a whole variety of things. And we also see much more pressure in the labor market, where we're seeing not only bonuses being offered for people even applying for jobs, but does that turn into, just rather than a one-off bonus, to higher wages? And then if firms say, oh, well, our costs have gone up, we can now charge more, people are willing to accept higher prices. And then individual workers say, well, I want more wages, and the labor market's so strong I can demand more, or I'm going to go elsewhere. We see a very high number of people who are quitting their jobs. We only see that when people feel very confident about the job market. And this gets back to the human condition, where people are, that psychology, that feeling of confidence is something that is very, very important, affects the labor market, and could affect the inflation process going forward. And that's one of the key things that the Fed has to look at. They want people to have confidence, but they don't want people to think, oh, well, that means that prices are going to start to rise in a consistent way, and that the Fed is just going to support that and lead to much higher inflation than they would like.
Randy, have you got any insight on the metric that's guiding this Federal Reserve right now? They talk about substantial further progress, then they won't tell you what it actually is. And I think each and every policymaker right now has their own view on that. Is it the employment to population ratio? We've heard that mentioned many times. Is it the participation rate? What is it for you?
So I think when you ask them, you are going to get different views. And I think there isn't any one magic bullet. I think the employment ratio, the number of people employed relative to population, is something that is important. And we see that going down because a lot of people have retired. No surprise during a pandemic and when there's a lot of uncertainty about the effectiveness of vaccines and concerns about health, that older people will say, it's just not worth it. I'm going to retire early rather than stay in the market. That's going to put more pressure on wages as the job market and the economy comes back, and there aren't as many people in that labor pool. So I think that would be a very important metric, and then also looking at the just what's happening to wages.
Professor, good to catch up. Good to see you, especially on Payrolls Friday. Randy Crozier there, University of Chicago
Governor,
Booth.
thank you.
School of Professor of Economics out of London. Your estimate today, 720,000. Your low, 400K. Your high, 1050. Mr. Shepherdson over at Pantheon Economics, Tom. Pretty bullish on this one.
Well, bullish, and there's some tendency upward as well. I don't have a strong feeling on it, John. And one of the things that would be interesting is if it's a yawn, if it's, if it just sort of comes in and we move on, because I think just as important is the month-to-month-to-month sequence. First thing I'm going to do with the revisions is calculate the 3-month moving average.
First thing I'll do, Tom, is look at how the market responds to it. We talk about that quite often. There is information in the data. There's a lot of information in how a market responds to the data. And yesterday we had this strange ISM. It had this really strong inflationary impulse to it, Lisa. And we ended the day with a curve flatter and yields at the long end lower.
The idea here is that the pressure would be short term. The more you have those sort of input costs going up, the harder it will be to get sustained inflation. That's not where inflation has to come from. As people say, it's from the wages side. And frankly, if people are having their buying power crimped, that's going to slow growth and slow inflation over the long term. That's why it's so important to keep parsing out where exactly the job growth is and where exactly salaries are increasing.
She will be here all morning, and she is not going to Crete. Tom, every time we say that Lisa's not going to Crete, people are going to start thinking that Lisa's going to Crete.
They are. The way
She's not going to Crete.
The way I look at it is we need to compare and contrast here. And we're talking to Governor Crozier of the recovery of Greece. And John, I was surprised still the Greek unemployment rate 17.3%. On a labor basis, it's still the basket child of Europe.
Some of those European countries, those labor markets are still pretty depressing.
I mean, they probably, the way I look at it is Actaeon Taverna, which is on one of the islands. I mean, they've been around for 90 years.
Yeah.
And if you were to have lunch at Actaeon Taverna on one of the islands in
Which
Greece,
island, Tom?
I don't know. You'd probably get marinated anchovies and boost the employment.
Yeah, thank you. Thank you for that.
Lisa's doing her bit for Southern Europe.
Exactly.
But not in Crete. 43.13 on the S&P. On this Payrolls Friday. This is Bloomberg.
With the First Word News, I'm Leanne Gerrans. The OPEC Plus alliance has fallen into bitter infighting. A key member, the United Arab Emirates, blocked a deal at the last minute. That forced the cartel and its allies to postpone their meeting until today. And it is casting doubt on whether there will be an agreement on production that could ease a surge in oil prices. Now, economists surveyed by Bloomberg forecast that U.S. payrolls rose by 720,000 in June, but recent forecasts have been much higher than that actual number. A variety of issues are probably keeping people from returning to the workforce, including enhanced unemployment benefits, childcare responsibilities and health concerns. The jobs report is out at 8:30 a.m. New York time. U.S. forces have left Bagram airfield in Afghanistan after almost 2 decades. Bagram was the epicenter of the war on the Taliban and al-Qaeda in the aftermath of the 9/11 attacks. Afghan forces will now run the airfield. President Biden promised that the last of as many as 3,500 American troops would leave Afghanistan by September the 11th. After 5 years of tension over Brexit, British Prime Minister Boris Johnson is laying on the charm for Angela Merkel's last visit to the UK as German Chancellor. Today, Merkel will visit Johnson at his country retreat and the Queen at Windsor Castle. I'm Leanne Gerrans. This is Bloomberg. Stay tuned.
couldn't agree more with our Treasury Secretary and with the use of the word historic, not just for economic diplomacy, but for fairness in the tax code, for multinational corporations paying their fair share, and for the American worker and the American middle class to get a fair shake out of a tax code that has been leaning the other way for far too long.
Fair. It's a word that's doing a lot of heavy lifting at the moment. Jared Bernstein there, Council of Economic Advisors member from New York City this morning. Good morning. Alongside Tom Keene, Lisa Abramowicz, I'm Jonathan Ferro. Equity futures 43.13 on the S&P. 6 days of gains coming into Friday ahead of the long weekend. It's like torture. Got to wait for the payrolls report. The weekend starts at 8:35 Eastern. 8:35 Eastern. In your bond market, yields in a basis point. 144.41. Dollar stronger, Lisa. Euro dollar 118.26. Just in case you might be interested in where the single currency is right now.
When is the real yield if the day ends at 8:35?
I am taping that at 8:40. Now I'm going to be here at 1 Eastern. Thank you, Lisa, for reminding me. Live on Bloomberg TV, 1 Eastern time. Just to get you into the weekend mood. Is anyone going to watch that, Tom? Will anyone watch that?
I think the people in Greece in anticipation.
Yeah, maybe.
Really?
What the real yield is in Greece
in
today.
a bar in Crete.
Now, we welcome all of you on radio
Crete.
and television. We're having a little bit of fun today into this important jobs report. And markets seriously beginning the second half with some real sobering movement for those cautious as well. Never cautious is Emily Wilkins looking at the pulse of Washington. Emily, I want to go 45 miles north of Kabul. We saw it overnight, some of the reports that the United States abandons Bagram airfield in Afghanistan. What is the symbolism of that?
I mean, this is an airfield that the U.S. has been at for around 2 decades, and it's part of the withdrawal as troops return back home after President Biden's orders that the U.S. would be getting out of the country. And I think there is a lot of people who are watching what is happening over the long term, trying to see what the actual impacts are going to be. A lot of concern that when the U.S. leaves, that other terrorist groups will regain a foothold within the country, and that could be a problem for a lot of residents there.
Foreign Policy magazine a few years ago did a wonderful map of Afghanistan, of the many plural strongholds of the Taliban. Many of those are near the airfield. Is this somewhat like the abandonment of Saigon, where they will move right in? Is that just anticipated by the administration and the Pentagon?
When you hear the administration be questions about their withdrawal from Afghanistan, one of the things that they say is, we're not completely leaving. Sure, the troops are going, but we're still going to have individuals on the ground in helping roles, in diplomacy roles. The U.S., the Biden administration at least, is trying to frame it as though they are not abandoning the country. But of course, I think time will tell, right? We're just going to see how it plays out in the next months as far as exactly what happens when U.S. forces leave these areas that they have been in for so long.
Emily, just to turn to domestic policy briefly, the big tax effort on an international basis, everything they're doing at home here in America, I keep hearing this word fair. And the word fair is doing a lot of heavy lifting because I'm trying to work out what the actual objectives are, the numerical objectives. This is a program where we try and look at the data. When they say fair, what do they mean?
Well, remember that these tax proposals are supposed to be doing 2 things. I mean, number one, they are supposed to be giving lower and middle income Americans who have a sense that the tax system is stacked in favor of wealthy corporations and wealthy elites, that it's going to be fair for them as well. And we've seen things in the U.S. There was an article that came out just a few weeks ago, I think, by ProPublica that showed that some of the biggest names of billionaires in the U.S. paid little to nothing in taxes. And there is a growing sense within the American public that that's not fair, that they're not getting the right shake. But remember, the whole point of this as well is to actually pay for other programs that the Biden administration is putting forward. They're proposing expanding childcare. They're proposing expanding elder care. There's a potential they could expand healthcare, Medicare, climate change initiatives. All these things need to be paid for. And the way to pay for them are these tax proposals that are being put forward and that Senator Bernie Sanders is currently working into a potential $6 trillion reconciliation package that Democrats are trying to find some way to pass within their party, which is obviously split between moderates, progressives, lots of different ideas there.
President Biden, meanwhile, Emily is going to be speaking at 10:15 after the jobs report. What is the political angle that you expect to hear from him?
President Biden, the train in Washington, D.C. to get this infrastructure package done, as well as the reconciliation package, it's not going to stop for a couple of job numbers. Obviously, the jobs report is closely watched in Washington. It is very much paid attention to. You have a bunch of releases that will come out. Republicans will say, oh, the jobs numbers show that, we shouldn't be passing these big spending packages. Democrats will say the job numbers show that we need the big spending packages. Everyone's just going to spin this to their own ends, and then they're going to go back to try and negotiating a way forward on these two bipartisan infrastructure and then the Democrat-only reconciliation bills.
Emily Wilkins down in D.C. of Bloomberg Government, thank you. If we can just focus for a moment on tax policy in America. Emily mentioned that ProPublica piece that came out a couple of weeks ago. The issue I always have with these pieces is they're almost hit jobs to achieve something elsewhere. If I asked you the question, how many billionaires are there in America, would you come up with the answer of 800? And given the way that some people speak in DC, it's as if there are tens of thousands of people with excessive amounts of wealth in this country. Now, Lisa, I'm not here sitting trying to defend anyone. That's not what I'm doing. I'm just trying to make sure that we don't conflate the extreme amounts of concentrated wealth held by just a few people with some people who have gone to work, they're very well educated, and they're getting monthly income of a certain amount that this government wants to go after. Now, I don't think you can say that this is unfair over here, which means we need to do something about over here as well. They're conflating two very different issues.
The thing I'm struggling with, I think that this is a good point. What I'm struggling with is why is this the agenda versus what we want to get done and how we're going to pay for it? Why is it a matter of justice and fairness, which are these subjective kinds of terms, when it could just come down to, what the goals are? And I think that you said this earlier, the word fair kind of doing a lot of heavy lifting, John, for some of the objectives, which are a lot less clear because there isn't necessarily consensus.
And you remember they used to talk about millionaires down in Washington, and they don't anymore because many of those senators are millionaires themselves. So the billionaire stuff is almost red meat to try and do something somewhere else. And Tom, we have in America a very progressive income tax code. It's highly progressive in America. And I think if you want to do something about wealth and concentrated wealth, by all means, that's a policy decision. It's not for me to say you shouldn't. What I'm saying is that you have concentrated wealth, that's one issue. And then you have flow, you have income, monthly income, annual income, that people do pay their fair share of taxes on because they have to. They get paid and it gets taxed before it hits their bank account, Tom.
It's a convenience to conflate wealth dynamics with income dynamics. And John, what is so important, and I've lived this, of course, over years, is the summation of your taxes. If you sum your taxes now, the answer is it's a very high total percentage of your income. That's the agony that you're hearing from so much of America.
Tom Keene, Lisa Abramowicz, Jonathan Ferro. Equity futures on this Payrolls Friday, 41.13. We're positive 0.05%. Payrolls, right. 2 hours, 5 minutes away. Your estimate this morning, 720K from New York. This is Bloomberg. Live from New York City for our audience worldwide on this Payrolls Friday. Going into Payrolls, 6 straight days of gains on the S&P. Longest winning streak going back to February of this year. 43.12 is where we are on the S&P 500 this morning, advancing around about 2 points. That's the equity price action. Here's the bond market, 2s, 10s and 30s, and here are the estimates. 720K is your median, the low end 400K, the top end 1050. This really big grouping in and around 700, 800,000. Going into that, yields just a little bit lower, down by about a basis point on 10s to 144.24, just a little north of 2% on a 30-year yield. But we've been coming in over the last couple of days, just grinding a little bit lower, even with an ISM with a really strong inflationary impulse. The curve yesterday, end of the day, a little bit flatter. What's the Fed going to wait for? Switch at the board and finish on this. I think it's an important chart, an important visual. It's the employment to population ratio in America. Big gap lower through March of last year, and then the recovery, and then we stall. We start to flatten out a little bit. And TK, the Federal Reserve, and a lot of people on the FOMC, they want to see that gap close. And right now, it's not closing quickly enough.
Yeah, and it's the x-axis as well. How long is this going to take? We've certainly had a number of conversations, John, over the last couple of days about the mystery of what August looks like, or November, or even the first few months of 2022. Always focused on the x-axis. Carl Riccidona joins us right now, Bloomberg Intelligence Chief Industry Economist. Carl, you absolutely nail an observation that restaurants and bars, bartenders and waitresses, it's a New York, California thing. Maybe the rest of the nation's okay, but you go further and say if you pull out restaurants and bars, it's a different labor picture.
Tom, good morning. Absolutely, it's a different labor picture. So we all knew that, of course, the most severely impacted categories during lockdowns would be the drivers of hiring in the recovery. So that's not a surprise. If we want to really understand the underlying momentum in the economy in terms of growth, inflation, et cetera, what we have to do is strip out those categories. So if we take out leisure and hospitality, what we see is an economy that certainly is growing, but not at those robust types of gains that we're seeing in the headline numbers. And if we even further dig into the details, if we take out all of the vulnerable categories, so it's dominated by leisure and hospitality, but take out other categories that also showed a significant impact during lockdown, we're looking at a 3-month average on hiring of about 160,000 per month. Now, ADP, the consensus, a lot of folks have overestimated payrolls over the last couple of months, and I think that tells you about some bias in the talking heads versus what's actually happening in the details. And so my bet is that, again, today we're going to, show some acceleration relative to last month. But my personal opinion is we could be setting up for another softer than expected number.
See, guys, how he slams us by calling us talking heads. Nice job, Carl. Carl, if we look to the jobs report, we tear it apart. Part of it is wages. I note wages less burgeoning inflation is a negative real wage. How long do we sustain a negative inflation-adjusted wage?
Well, I think we're going to sustain that well into the back half of the year. So those retail workers and warehouse workers who got a $15 minimum this year, that was a great improvement in their immediate economic situation. But that's getting very rapidly eroded away unless those wages are adjusted to inflation, which in most cases, that is not what's happening.
Carl, can we get to the mystery chart? The employment to population ratio has flattened out, hasn't improved with the pace that I think a lot of people wanted to see. The participation rate in America captures the same thing, flattened out. I think we're pretty much where we were in fall still right now. What explains that for you, Carl?
Well, I think we have to be nonpartisan and objective in thinking about that. And it's a number of factors. Lisa highlighted them earlier on the program, whether it's at-home learning, lingering concerns over the, public health issues, also perhaps some discouraged workers in specific industries and whatnot. It's really a confluence of factors. That huge collapse in participation, I absolutely think can be mended. So maybe there's some retirements to factor in there. But what's interesting, earlier we heard from Philadelphia Fed President Harker, who said the Powell deficit, which Chair Powell keeps highlighting at about 7.6 million workers relative to the start of the pandemic. President Harker said that could be closer to about 10.5 million given growth in the labor force. So if we are truly focused on economic scarring, and that is something the Fed is very much focused on, maybe some of the hawks are a little bit less concerned about that, but Jay Powell, Clarida, the center of the committee, New York Fed president, they are very much focused on this economic scarring issue. And that means we don't have to look at a vast array of metrics when we think about the dashboard. We have to look at that labor market deficit relative to February of 2020. It's 7.6 million right now, John. That's basically where we stood at the end of the recession in 2009. And so as we think about labor pressures and inflation pressures in the economy with that much slack in the labor market, I don't think we should be expecting a very different outcome for inflation this time around compared to the last time we saw such a large deficit, which was coming out of the 2009 recession.
Carl, I just want to break out a few things you said. When I asked you that question, what explains it, you went point by point, and Lisa's been talking about it as well over the last several weeks. And many of those points, including things like the additional unemployment insurance, the care for children, childcare, all of those things, that's temporary and can be solved with time. Then you mentioned retirements, and then you went to scarring. Now, I don't want to get into the semantics too much, but scars are permanent. And I wonder if scarring is actually the best justification for being a hawk on the Federal Reserve right now, because quite simply, maybe the participation rate won't recover in the way that some of the dubs are anticipating if they wait longer. And quite simply, maybe for some people on the Federal Reserve, they might not be the ones to help here.
Well, scarring doesn't have to be permanent. If it's, the main point of the dubs on the committee is that if they put the right policies in place, we can avoid some degree of scarring. Now, there will be obviously some consequences, but Fed policy will very much impact how much those long-term economic consequences exist in the post-COVID economy. And so that's why Jay Powell wants to run a high-pressure economy, run things hot to bring folks off of that sidelines. Either they were permanently on the sidelines and maybe now are entering the labor force for the first time, or had become discouraged and can be encouraged to re-enter the labor force. This has vast social consequences, and we were there in 2019 as people were saying the economy is overheating, and Powell was taking the benefit of the doubt and trying to run things hot and wasn't seeing things hot. As he said, to run things hot, you have to see heat. We weren't seeing that in 2019. So I think we can get back down to the debate of 3.5 or lower on full unemployment, and the Fed wants to get there. So I think pulling back policy too soon would then potentially lead to that type of scarring in the economy. And one additional point I want to make, John, folks are considering these extended jobless benefits as a reason that we're seeing elevated unemployment and sluggishness to return back to the labor force. That doesn't really get solved in this jobs report. There were only 4 states that terminated the extended jobless benefits. So if you're looking for a big pickup in hiring because those jobless benefits are expiring, don't look for it in the June data, and you're only going to see it in relatively small states in the July data. It's going to take until later this summer to really see the consequences playing out in those specific industries.
Carl, this may be particularly granular, but I think it's really important to dig into the concept of scarring. How much of this is a mismatch in skills, a necessary retraining for people based on some of the big shifts in the economy that have been turbocharged toward e-commerce, that have been turbocharged toward the internet?
Well, I think we can see that this is, very significant. If you look at things like the beverage curve and whatnot, we can see that, there's a lot of job openings and not as much job placement as one would expect happening in that environment. That's telling you that there's some frictions here, speed limit effects in the economy in general, and more specifically, the ability to land skilled labor in the right positions.
And very importantly here, John, beverage is not the beverage of your choice. That would be the esteemed economist and leader of London School of Economics. Arguably, Mr. Beveridge saved the London School of Economics a few years ago.
I appreciate you clarifying the point. Thank you. Carl Riccidona of Bloomberg Intelligence.
Speaking of beverages, they serve it, John. This is, our listeners have really come in here on this sojourn to Greece here. Dr. Alarian celebrating the general admission of Queens College yesterday, a great honor as president of Queens College, notes, and of course he is a global traveler. That ticket to Crete it's
how much
John,
is it?
It's like the edge of Shanghai. It's like 7,000 large.
7,000.
He says that's pretty rich.
Is that business class?
That's of course. Well, that's the only way Ms. Abramowicz is going to go.
Well, of course.
The value add is really tremendous.
I think it's with 7 stops.
I just think your privacy is important, Lisa.
Thank
so we
you,
keep communicating to our audience. She's not going to Crete.
No.
Or the Dodecanese. I believe the Dodecanese. John, the Dodecanese have been pushed out as well.
We're done with this now.
No, we're not.
We're going to keep it going.
It's going to endure right until she goes out the door.
Your market this Friday, 43.11 going into the payrolls print. And I want to reflect on that ISM a little bit more.
Please reflect.
What the ISM do, and I think it's quite nice, and Lisa, I know you read through it too. Tom, I'm not so sure. When you go through the industry responses, point by point, chemical products, manpower has been a concern, machinery, supplier costs up, materials, labour, shipping, electrical appliances, lack of available labour. metals, the lack of labor is killing us. That's where the tension is right now, still in this economy.
And what is it that's causing people to remain out of the labor force, given that the participation rate is so low relative to where it was pre-pandemic? We don't really know, and I think that that's what Carl was pointing to. We don't know how much of this is scarring, and to the effect that we do understand that more later in the year, we'll understand more about what the Fed's thinking is, and perhaps why the bond market is so sanguine about inflationary prospects.
Well, Tom makes this point and has done for a long, long time. When you have this kind of gap between demand and supply, what fixes it, Tom? Price. Wages.
Always.
Yes
wages.
and no. I mean, yes and no, because if people do not have the skills, they cannot fill some of these jobs. And when you talk about coding, when you talk about certain jobs, I mean, that's idiosyncratic. I understand that. But there is a question of whether there's a skills mismatch and who's going to pay for the retraining.
There was a phenomenal study done out of Iowa, I'll say 15 years ago, on welders. The elasticity point is wage. They come out of the woodwork with wage.
144 on 10s this morning, 43.12 on the S&P. Up next, Andrew Pekos, Johns Hopkins Bloomberg School of Public Health professor and virologist from New York City this morning. Good morning. All-time highs going into Payrolls Friday, just ahead of a long weekend. Full coverage right here on Bloomberg TV and radio. This is Bloomberg.
With the First Word News, I'm Leanne Gerrans. There's growing doubt there will be an agreement between OPEC and its allies that will ease the surge in oil prices. The alliance fell into bitter infighting after a key member, the United Arab Emirates, blocked a deal at the very last minute. That forced OPEC Plus to postpone its meeting until today. It could mean there will not be any increase in production. Now, the IMF predicts that the Federal Reserve probably will need to begin raising interest rates as soon as late 2022. Staff at the Washington-based fund also said the Fed will likely begin scaling back asset purchases in the first half of next year. At last month's meeting, 7 of 18 Fed policymakers indicated they want to raise interest rates in 2022. And Richard Branson plans to beat fellow billionaire Jeff Bezos into space. Branson will fly on the Virgin Galactic test flight on July the 11th, along with 5 others. That's just 9 days before Bezos plans a trip to space aboard his rocket made by his company, Blue Origin. He and the crew will be joined by 82-year-old Wally Funk. She was one of the first women to train for space flight, but she actually never made it on a mission. Global news 24 hours a day, on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Leanne Gerrans. This is Bloomberg.
Good morning. I'm Romaine Bostic outside the gates of the beautiful Tanglewood Music Festival right here. We're in just a few moments. These gates will open and we will begin rehearsals for the July 4th Boston Pop Spectacular. Of course, this is going to be the first event at the Tanglewood venue since the COVID crisis. We'll feature Mavis Staples, John Batiste, of course, all under the helm of conductor Keith Lockhart of the Boston Pops. The Symphony Orchestra here will be performing. Of course, we will also have the 6 singing sergeants of the U.S. Army, as well as the U.S. Air Force Band here, right here in the foothills of the Berkshire Hills. It will air, of course, on Sunday, July 4th, 8 p.m. This is Bloomberg.
We observe something really interesting when we compare wars and pandemics, right? Because both have loss of life. But in pandemics, there is an increase in real wages after the pandemic. And it seems like there is some hesitancy to go back to in-person work after pandemics.
Constance Hunter there, the KPMG chief economist from New York City this morning. Good morning. Alongside Tom Keene, Lisa Abramowicz, I'm Jonathan Ferro. On this Payrolls Friday, let's get you set up with some price action this morning. 6:48 Eastern Time in New York, 43.11 on the S&P. Totally unchanged. 6 days of gains coming into Friday. Quite a winning streak on a daily basis, the longest we've had since February of this year. Yields have been coming in again. We're down 2 basis points. This is becoming a grind down towards 140 now. 143.56. TK, we come in another 2 basis points.
Yeah, the grind is there, and it goes both ways. You see it in the stronger dollar as well, 92.61. I'm actually watching dollar carefully. With euro, not much, but yen is weakened this week, 111.42 as well. On the pandemic, and on Los Angeles, Andrew Pekos from Baltimore with Johns Hopkins Bloomberg School of Public Health this morning. Andrew, I was really taken aback by L.A. with some, very measured tone, no panic, saying, hey, Delta India variant, maybe we ought to kind of like have the vaccinated wear masks again. Were you surprised by that news?
I wasn't surprised because we have to think about things in terms of the local spread of the virus. So, for example, here in Baltimore, we have a very low case positivity rate. We have a very low testing rate, a good vaccination rate. So we don't have those kind of restrictions that are being considered to put in place. Los Angeles is a very different story. The Delta variant there is moving very quickly. It's moving through unvaccinated populations. And even though the vaccine does provide protection against Delta, it's always good to have more than one thing in place, particularly when the risk is getting higher. And masks represent one extra thing that a vaccinated person even can do to prevent infections in a situation where you might have a high chance of being exposed to the virus.
Any number of studies, including Bloomberg. I noticed the Washington Post this morning with a round number, 47% totally vaccinated. What number do we need to see?
It keeps getting higher and higher as we find variants that are more easily transmitted. We were using the 70% number early in the vaccination campaign. That was before Alpha variant came through, and that was before Delta variant came through. When viruses become more transmissible, the number of vaccinated people we need to reach that herd immunity threshold gets higher and higher. People are coming up with numbers now, but I wouldn't be surprised if you saw a number now of 80 or 85% to really reach that level of herd immunity where we get the population benefits, not just the individual benefits of vaccination.
Professor Pekos, I feel like I Google this every night and get a different answer. So please provide some professional advice and guidance here. What does it mean the vaccines protect people against the Delta variant, that they protect people against the coronavirus? Is it simply that they don't get fatally ill, or is it that they actually do not get sick and cannot transmit the disease?
Yeah, so with Delta, the data is still coming out. We have about 3 studies that are out there right now that show that if you're fully vaccinated, meaning for the mRNA vaccines in particular, that you've gotten both doses and you're at least 2 to 3 weeks out from your booster dose, in those situations, you're seeing protection against all aspects of disease, severe disease, hospitalization, as well as what we call symptomatic infection. So the data with Delta looks good, although again, it's just a few studies right now, and we need more data from that. The risk though is not minimal, right? Vaccines are not perfect. And with a variant that's more transmissible, you might expect to have a slightly increased risk, even if you're vaccinated, of getting infected. But the vaccines are protecting, and that's the important message to get out there. When we talk about surges with Delta, we're probably talking about surges that are going to be primarily in the unvaccinated population, because the vaccinated individuals in our population will be protected.
Dr. Pekos, is it concerning to you that the Delta variant is something like 60% more transmissible, according to some studies, than even the B.1.1.7 variant, which was itself much more transmissible than the original strain? The trajectory here does not seem to be that great. Are we seeing a similar type of evolution in the gamma strains that people are picking up and others?
So far, Delta is the one that I think we're most worried about, because that increased transmission is really giving the virus what you can call a new platform to accumulate more mutations on. We're always concerned about mutations that'll evade vaccine-induced immunity. But those mutations put on a highly transmissible virus makes it a higher risk. We have something we call viral fitness that we measure all the time, and a virus that's more fit can handle some mutations that may be a little deleterious, but it still lets that virus circulate in the population. So as we get variants that are better and better at circulating, the potential for getting the vaccine escape mutations in those backgrounds represents a risk that scientists like myself are very, very concerned about.
Andy, it's always good to catch up and get your insight. Some clarity on some important issues there. Andrew Pekos there, the Johns Hopkins Bloomberg School of Public Health professor and virologist. Is July 4th still Independence Day from the virus in America, Lisa? Or have we pushed that to one side? I haven't heard anything about that in D.C. this week.
The messaging is so delicate here because on one hand, you do have pockets of the population that are very highly vaccinated. I'm thinking of New York City and other more urban regions. And then you have places, particularly in the South, where the Delta variant is spreading very rapidly and where people are not vaccinated. And President Biden isn't going to want to sound the all clear if you have that kind of mismatch in patches of unvaccinated individuals.
The IMF sounding the all clear for the path forward. I don't know if you both saw this yesterday, but they put out some new assessments of US growth. GDP in America for the IMF, 7% this year, and an upgrade to next year as well, Tom. This might get your attention, up to close to 5% for GDP growth for 2022. That's the call coming out of the IMF.
Yeah, I thought the IMF's, it got attention, but also, John, what I'm looking at is the earnings before the earnings. And we saw earnings yesterday, any number of people, including McCormick of Baltimore, the Spice people, where, you know what, they were pretty good. And to me, it sort of overlays onto the improved IMF view.
July 13th, JP Morgan up first.
Yeah,
And I've got to say,
July
Tom, I'm
13th.
looking for the commentary about how they're dealing with higher prices. The ISM prices paid for materials measure, 42-year high. You've got to go back to the Iranian Revolution, Tom, in the late 70s, for when we had a read that big. Coming up, Priya Misra on prices in America and what it means for this bond market. The head of rate strategy at TD joining us shortly. 143.90, yields are in 2 basis points on its Payrolls Friday from New York City. This is Bloomberg.
I think consumers have money in their pocket, and we're going to have a super holiday season.
I do think we're far enough along that a lot of that scarring should begin to dissipate.
Even if the economy slows, rates stay low, inflation's going to moderate, and we're still going to get positive long-term equity returns.
We think any pullbacks or any pauses in the market could be short-lived and shallow.
Clearly, we're heading towards an environment where they have to consider tapering.
This is Bloomberg Surveillance with Tom Keene, Jonathan Ferro, and Lisa Abramowicz.
90 minutes away from the Payrolls report from New York City for our audience worldwide. Good morning, good morning. This is Bloomberg Surveillance live on TV and radio alongside Tom Keene and Lisa Abramowicz. I'm Jonathan Ferro. Friday morning, good morning. 43.13 on the S&P, all-time highs, TK, going into the jobs report.
All-time highs, a boom economy, and I think it's really important to focus on the labor economy and how it folds into 2 things, John. One is that guesstimate on the economy. Guess what? The guesstimates have gotten more positive and constructive, and the other is the inflation dialogue overlaying it. Maybe that's a mystery, but most people summing up higher inflation, big nominal GDP. I'm sorry, that means job formation.
Words matter, guesstimate, and I think that is just what it is, Tom.
Yeah.
Going into payrolls with a wide range of estimates once again, with 400K at the low end, 1050 at the high end.
The numbers are there. I mean, we're going to look at that headline number. John, I'm going to go to wages, less what I was talking about, which is rising inflation. There is a negative real wage in America. That's never good.
Do higher prices fix the problem in the labor market, Lisa?
Not unless those higher wages turn into equally higher wages, the higher prices. The question that I have, as you guys were talking, is if you have wages that are lagging behind these other input prices in terms of inflation, you do not get persistent inflation that the Federal Reserve is looking at. And I think that perhaps, John, is what you're seeing in the ISM data. That's what you're seeing with respect to the commodity prices and the response in the bond market.
We need to work out the response to the bond market. I think that's where we've got to start this morning. Yesterday we had this really strong ISM, still north of 60, but with a really strong inflationary impulse to it. Prices paid 42-year highs. Now, if I gave you that information, what would you do with it? What would you expect to happen in the bond market? High yields, Tom, steeper curve?
Steeper curve.
Lower yields, flatter curve. That is what we got. So I think you've got 2 choices right now. Either this market believes, like the Fed, that this high rate of change of inflation is transitory, or an alternative explanation over the last couple of weeks is that you believe now that when higher prices start to come through, you question the reaction function of the Fed, you believe the Fed has to move quicker, and it chokes off what could happen with inflation translating into higher yields. What are two options there, Tom?
I'm going to go with, I don't know what the dynamics are going to be. It's like in a Newtonian plumbing system of the 19th century. And also, we're in an area, John, we've never been before. I'm going to go back to the 3-month moving average on non-farm payrolls. And my guess is it's going to be pretty constructive. I could be wrong.
720, that's the estimate going into the payrolls report. It is 90 minutes away. Here's the price action. 6 days of gains on the S&P 500. Could it turn into 7? The fate of the trading day may be in the hands of a jobs report that comes at 8:30 Eastern Time. 43.14 on the S&P 500, advancing almost 0.1%. Yields are in again this morning, down a basis point to 144. And in euro-dollar 118.31. Tom pointed it out earlier. A stronger dollar in the mix again this morning. Lisa, against the single currency.
Yeah, perhaps the belief that they will have to raise rates, although unclear perhaps that Europe will remain easier than the U.S. for longer. Hard to understand the dollar strength if you do believe the reflationary story, which obviously is getting challenged at least by the yield curve. 8:30 a.m. we get that U.S. June jobs report. I'm going to be looking at the services dynamic that Carl Riccidona was talking about. How much of the job gains really are stemming from some of the main areas that were shut down during the pandemic that are restarting most quickly versus the rest of the economy? How much momentum is there under these gains? 10:15 a.m. we hear the political spin. President Biden is speaking about the jobs report. Expect him to talk about enhanced unemployment benefits, the highly political issue of if you're paying people more to stay out of work, why would they go back and get a job? People have blamed this for some of the lag, some of that friction, and there have been a number of states that have ended it, as we've been talking about. And today, OPEC Plus will continue to negotiate output cuts. And I think this is actually one of the big sleeper issues, Tom. And I think it's important to take a minute on this. Basically, there was a disagreement in the OPEC Plus members, and the United Arab Emirates pushed back on the process by which they measured output. They did not come to an agreement. If they do not come to an agreement and they don't raise production to meet the increased demand, you will have a rollover of right now the production limits, which means that the supply will not necessarily meet demand in the same way, leading to higher prices. A key question, John, as we go forward. Tom, do you have something to say?
I got to jump in here because I just think it's important, John, that we see Ms. Abramowicz with a European focus on her work today.
Absolutely.
Of course, John and I will be enjoying rain-swept New York City here. It's one of the islands. It's not Crete. But let's go to the Greek data check right now. John, we can do that with Athens equities up at an 888 level. Euro-dollar, you've got to look at. I believe they use the euro on one of those islands in Greece. 118.33.
Thank you.
And I think that's the price of feta. No, that's the national. I thought it was the price of feta cheese. It's the National Bank of Greece, John.
Don't offend too many people, will you, Tom?
No, I'm working on it, Mr.
You keep working on it.
Good to have you watch us this morning, Prime Minister.
Euro-dollar 118.33. Lisa, do you make the change at the airport? Do you just pay on your card? What's the plan here?
It's a card.
What's the plan?
There's a system in place. We have some euros.
Oh, you have some euros already?
Yeah.
What was the exchange rate for you? Clearly not at spot at 118. What did you get?
I don't remember.
And of
don't
course,
remember.
John,
isn't that a lovely luxury to have, Tom? To
John,
go away and just not remember how
or
much
not
it
even
cost to
tell
change
us.
the money?
I mean, we couldn't even buy.
Would you like to know anything else?
Yeah, I'd like, we're looking at guesstimates this morning on the jobs report, and I'm looking, John, at the guesstimate of which Greek island we're
not Crete.
We're like 0 for 12.
Let's move on.
Not Crete. Lisa, thank you.
Thank you.
I'm
going to enjoy next week.
Thanks.
We all will.
Maybe she'll stay around for 8:30.
You tune in. Might get a remote from Lisa in the field.
Field report.
Not from Crete. Priya Misra joins us now, TD Securities Global Head of Rate Strategy. Priya, what a start where we opened the show. And I know you're on the same page. Yields and the behaviour and how markets are responding to economic data. Yesterday, a nice case study. What explains it?
I think it's the market pricing in a more hawkish reaction function, frankly. I mean, if you look at long-end inflation expectations, they've declined. The market's taken the terminal rate of the hiking cycle and lowered that. We were pricing in 2% at the end point of the hiking cycle in March. It's pricing in less than 1.5%. So the front end, I think the market's telling you that the Fed is going to be forced into hiking for some reason, perhaps inflation, and that the economy can't handle it, which is why the hiking cycle will be cut short and it could potentially, slow down growth going forward. That's why that yield curve has been flattening. And I think it's a misinterpretation of that June FOMC. I think there was a lot of confusion, huge market reaction on the back of that meeting. I don't think it was a change reaction function. I think it was an acknowledgement of the upside risks out here. But I think the market's sort of running with a more hawkish reaction function, and perhaps that the Fed's commitment to that FAIT approach is weaker.
Priya, does this jobs report adjust the taper talk or adjust the guesstimates of what we'll see at Jackson Hole?
I think both. I mean, they are sort of linked because, we know that the Fed has sort of opened the door now. They're at least talking about tapering. So now I would argue every data point now is going to be a market event. I think, because they've put the market on notice. So whether it's Jackson Hole, if you get a really strong number, if we see high wages, I think the market's going to say, okay, maybe Jackson Hole or the July Fed, the Fed might signal tapering sooner. And the issue is tapering and the first hike are linked. I mean, what's the time period between the end of tapering and hiking? Some Fed officials think it's a couple of months. Others think it's a year out. We don't know that time period. And that's why I think if the tapering time frame moves sooner, based on today's number, I think that hiking timing and the hiking pace could also increase. So it could be another flattening reaction, which will seem a little bizarre if the data is good. And we really need to see how the Fed pushes back. Do they actually say that they want to see the supply chain disruptions? And, even in the labor market, I would argue there's a lot of frictions, and they'd want to at least wait until September before they can, sort of take the victory lap.
So just to take the flip side of this, Priya, that means that if it's a disappointment on the number, that you could see yield curve steepening.
I do think so, yeah. I think that front end is going to push out the timing of the first hike to potentially early 2023, mid-2023. And the long end, then maybe the reflation trade comes back. It seems a little counterintuitive, but I would say price action in the last couple of weeks is symptomatic of a reaction function shift, not economic data, which is why we're getting weird reactions, I would argue, to economic data. So yeah, I think a weaker number pins the front end a little bit more, and the long end, then inflation risk can start to rise in the long end.
If you can, just reiterate your year end on a 10-year now. What is it?
We're looking for 2% on the 10-year because we're looking for the Fed by December to actually announce tapering. Now, it's a long way from hiking. Our hiking call is much further out, so you can probably tell why I like the steepener. I think the bar to hike for the Fed is much higher. They want an inclusive recovery. They want inflation to persistently, be or at a sustained basis be at 2% overshoot. So I think, but the tapering bar is not that high. So the reason I've got this higher rates in the long end is this idea that the Fed will taper. We have a ton of treasury supply that we have to take down. So to attract that marginal buyer, both real rates as well as inflation expectations will need to rise.
Priya, thank you. Good to catch up with you on Payrolls Friday. Priya Misra there of TD Securities. Your yield right now on 10s, 144 year end. The forecast, the estimate coming from TD, 2%.
John, can you imagine getting a 30 or 1.99? I mean, nobody's expecting that.
5 basis points away right now, Tom.
Yeah.
Down 2 basis points on the day.
It's moving that way as well.
I mentioned the IMF a little bit early this morning, Tom. Lisa, they also offered a timeline for the Federal Reserve, which I found quite interesting.
I didn't understand this, and I'm wondering whether they're basically trying to get the U.S. to move first to give some sort of leeway to other central banks around the world to start raising rates. But honestly, for them to say you should probably start to raise rates by the end of 2022 and probably should start tapering pretty soon, when is there a precedent for the IMF giving the Federal Reserve recommendations on policy?
I remember a certain President Lagarde. Tom, do you remember that news conference where Madame Lagarde said about not doing too much too soon and try to push back?
And there was a tantrum. I mean, that's the big fear here, John, is to repeat what we saw a couple years ago. And, to be honest, John, everyone's managing the message. I mean, you're going to see that with the Secretary of Labor later this morning.
145 on 10s going into payrolls. We will catch up with the Labor Secretary, Marty Walsh, a little bit later this morning following that payrolls report. The number out at 8:30. About 60 minutes later,
John,
we'll hear from the White House.
Maria Tadeo killing it with research. She's also reviewed things, not Payrolls, not EOS.
So we've taken 3 islands off the list.
We have.
It's good to know.
Thank you, Maria Tadeo.
Thank
for
you,
that
Maria.
news we can use.
We might find out by the end of the show.
We might.
Where Lisa is going on vacation.
It's just,
It's like a game show.
Yields down 2 basis points, all-time highs in the equity market. Payrolls Friday from New York on radio and TV. This is Bloomberg.
With the First Word News, I'm Leanne Gerrans. The OPEC Plus alliance has fallen into bitter infighting. A key member, the United Arab Emirates, blocked a deal at the last minute, forcing the cartel and its allies to postpone their meeting until today. It's casting doubt on whether there will be an agreement on production that could ease surging oil prices. Now, economists surveyed by Bloomberg forecast that U.S. payrolls rose by 720,000 in June. Recent forecasts have been much higher than that actual number. A variety of issues are probably keeping people from returning to the workforce, including enhanced unemployment benefits, childcare responsibilities, and health concerns. The jobs report is out at 8:30 a.m. New York time. Now, a group of Republican senators want President Joe Biden to end the trade war initiated by Donald Trump. The 7 lawmakers wrote to the president asking him to revoke tariffs and other barriers imposed on China and European allies. They refer to the trade war as self-inflicted harm. After 5 years of tensions over Brexit, British Prime Minister Boris Johnson is laying on the charm for Angela Merkel's last visit to the UK as German Chancellor. Merkel will visit Johnson at his country retreat and the Queen at Windsor Castle. She'll also have the very rare opportunity to address the British cabinet. Global news 24 hours a day on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Leanne Gerrans. This is Bloomberg.
Of course, the nascent recovery still faces uncertainty, also due to the spread of virus mutations. In the current phase of the pandemic, our concerns about financial stability are shifting from liquidity risks in the non-financial corporate sector to balance sheet vulnerabilities in that very same sector.
The ECB president there, Christine Lagarde, on the situation in European markets from New York City this morning. Good morning. Alongside Tom Keene, Lisa Abramowicz, I'm Jonathan Ferro. Equity futures 43.14, pushing 43.15, up around about 1/10% after 6 straight days of gains on the S&P 500. It has been all-time high after all-time high through the week so far. Your payrolls report 1 hour, 12 minutes away. Going into that, yields are grinding lower, down a basis point to 144.24. And in the FX market, euro-dollar 118.34, down a little more than 1/10% on the euro. Earlier this week, Tom, I think it was you that sent me the research of Kit Jukes, potentially over at SocGen, envisioning a 110 going into, say, 2023, with a dominant factor being short-term rates in America, and what happens there is going to drive that US dollar.
Well, some of the mystery to see what the dollar move is off of 8:30 this morning. John makes a joke at 8:32 it all ends. Well, you guess what? A lot of research will be written, and we'll bring that to you through the morning and on to the real yield this afternoon. Right now joining us, and it is an acclaimed spot, particularly on a July morning where at any moment she could be drowned out by the lawnmowers of the North Lawn of the White House. The history here is great. They were on the lawn. The journalists ruined the lawn. Then they put gravel down. They called it Pebble Beach. So joining us in the asphalt in front of the White House, commonly called Stonehenge, Anne-Marie Horton joins us from the Stonehenge today. Anne-Marie, July 4th is always hugely symbolic for senators and representatives. They go home, they kiss babies, etc. Yeah. What's their biggest worry right now with their constituents?
Well, Tom, I think one of the biggest worries right now is twofold. One, of course, is jobs. Given we're going to have that jobs report today, are enough people getting back into the labor force? Some states we already see are taking away some of that supplemental unemployment benefits because of that. Some states, progressives, are worried about child care. We have some, especially women, on the sidelines of this job recovery because they cannot get that child care. Second, there was a COVID briefing here, and the CDC is incredibly more worried about the Delta variant that started from India. And the Southwest and the Midwest, that is a key concern for a lot of counties that just don't have the vaccination numbers.
I'm so glad you bring this up, Anne-Marie, because this is front and center. We talked to Pecos at Johns Hopkins about Los Angeles. You mentioned the Southwest, and for the rest of us, fat and happy, I mean, this is a real deal for Los Angeles this 4th of July weekend.
It certainly is. And I just was in the United Kingdom where the Delta variant is. Yeah, and the Delta, of course I was. And the Delta variant, Tom, is just the main driver of all the uptick of cases. They are a little bit longer in rolling out the vaccines than in the United States, and they have a longer lag time between the first and second jabs. But that is the concern here. If you have a county that is not vaccinated, the Delta variant spreads much more quickly, and that is a key concern of the CDC. And some states, they say right now, it is already the leading variant.
And Marie, so what's President Biden's message to Americans, especially as he tries to highlight the progress that the United States has made with vaccinations, but also the uneven progress in specific places?
Yeah, I think he's going to have to really walk this fine line. For the last week, we've seen a lot of press releases from the White House touting their economic growth and the recovery. They even put out a how to have a cheaper 4th of July. Their take that inflation is transitory, that your 4th of July barbecue this year is cheaper. But at the same time, they want to make sure people are, A, looking for jobs. There are jobs out there. Are people looking, or are they just still accepting those unemployment benefits? And 2, to get vaccinated. If you have not been vaccinated, that's a key message from this administration, because what could derail this economic recovery, some would say, and question, is potentially this Delta variant.
Anne Marie, you talked about jobs and the spin after the jobs report comes out. You pointed to those enhanced unemployment benefits. What's the Democratic line on these?
The Democratic line is that they want to keep these enhanced unemployment benefits. Many progressives especially speak to the fact that there are a number of people who have not been able, because of the pandemic, to get back into the workforce. And until they're able to get efficient child care, schools are fully reopened, and they're able to get a job with wages to keep up with the pace of the country and inflation at the moment. So their take is that you keep them at least till September. But some states we already see, definitely GOP ones, are doing away.
Anne-Marie, we don't have you on for politics today. We've got to get a briefing here. You were in London. You were closer to Greece than any of us as well. And I need a briefing on the island of Lesbos and the making of ouzo, including ouzo Giannazzi. I mean, is Lesbos the kind of island that Lisa should go to?
I haven't been to Lesbos. I've been to a number of Greek islands. I don't know where Lisa's going. Maybe Corfu, Rhodes. Manus Cranny, he was my daybreak anchor in London. He's currently in Mykonos. So if you go to Mykonos, you have to at least have one night at Namos.
This is special.
One night at Namos.
John,
you know, I've frequented some nightclubs in Mayfair with Anne-Marie.
I have no doubt.
John.
And if there's one person in our staff that knows where to take a night out, Tom, I think it probably is Anne-Marie.
Too much information.
Yeah. What I want everybody to notice here, and for those of you on radio, this is really serious. These people have these romantic lives. Ferro's 3 weeks in Capri, and Anne-Marie and Manus are flying around. They've been to every Greek island. Lisa, leads a break. This will be great. What am I doing? I'm going to Three Guys on Madison.
Is that where you're going this
I'm
weekend,
going to
Tom?
I'm going to Three Guys this morning for a quick breakfast.
You're not taking a break?
No, I got to read all weekend.
Anne-Marie, I know you got to run. Anne-Marie Hordern.
She's never coming
our
back.
Washington correspondent down in D.C. We're trying to work out where Lisa's going on vacation.
It's not Crete. It's not
Crete.
I saw EOS and I thought it was Apple iOS. I mean, that's how clueless I am.
Classy, Tom.
Yeah, thank you.
Classy. Are you really not going anywhere this weekend?
No, I just was up in Maine for 2 fun-filled days.
You've had your break. Is that your summer vacation? You're so old school. Take some time off.
No, I don't. I work every day.
And then you can tell him that he's been on sabbatical.
Seriously, the CFO, the CFO of the Trump organization, in the reporting on his important indictments, he said he never takes vacation. I'm embarrassed by that. It's a culture. And I'm not proud of it, John. It's a uniquely American idiocy.
Have we done something to address it after the last 12 months we've just had?
I think so. Yeah, I think so.
Will we make that adjustment finally?
I haven't, but I do agree, John, there's going to be a reassessment.
Lisa, do you think we need to?
Yeah, I mean, yes. And I think that people are aware of the need, especially with the lack of divide between work and home when people are working from home. Whether that's actually going to be the case, I don't know. I mean, if people are going to be working from home more, does that just mean an extra 40 minutes on average of work?
We should state here, and Bloomberg's done great reporting on this, there's a serious mental health crisis coming out of this natural disaster.
Without a doubt.
Without a doubt.
Absolutely.
we're making jokes about it, but this is serious stuff.
I'm going to catch up with Megan Green, the economist, a little bit later, Tom. She's doing some work on that. It's really important. She's trying to talk about, Lisa, whether it's holding back this labour market as well.
And particularly among kids and people entering the labor force now. I mean, if you think about kids who've been out of school, not able to socialize, it's been a very difficult period of time.
Particularly the people going to Greece.
Coming up, Sarah House, Wells Fargo Corporate and Investment Bank Senior Economist from New York City this morning. 43.15 on the S&P. Payrolls, 1 hour, 5 minutes away. Your estimate, 720K. Heard on radio, seen on TV. This is Bloomberg Surveillance. This show is so much better in the commercial break. If only the mics were hot. From New York City, live on TV and radio, here's the price action. 43.15 on the S&P 500, advancing about 4 points, up about 0.1% after 6 straight days of gains. Yesterday's gains at an all-time high, driven by the cyclical parts of this market. Energy had a nice pickup off the back of that rally in crude. Tom, I'll get to the bond market just briefly, 2s, 10s and 30s, just to give you a flavour of where things stand going into the payrolls report, 60 minutes away. Yields come in about a basis point, 144.24 on 10s, on 30s. Yields in again by 2 basis points, just above 2% at 2.04%.
Yeah. And, John, this is a sensitive issue. It's well understood. It's within our agreements with Bloomberg LP. John and I are not allowed to be on the same plane ever. There's been a couple times, particularly to Davos, where this is really important.
For good reason.
And this is for good reason. And I really think, John, we've got to begin to consider that policy from Ms. Abramowicz and Ms. Lyons.
I was going to get there. It's going to get there.
It's serious stuff.
Just wait, Tom.
It's serious.
Part of comedy is just to build it up and then get to the punchline.
Really?
Let's just go through this bond market just a little bit.
I thought you already went through it.
No, I haven't finished yet. That's 2s, 10s and 30s. I want to talk about the shape of the curve as well, Tom. Switch out the board and get to that. The data's one thing. How a market responds to the data is the other part of the story. The second part for market participants, the most important part of the story. 2s, 10s right now, a break of 118, a 117.94. That's a flatter curve over the last couple of weeks.
And even in the last hour.
And again in the last hour. So, Tom, here's the question for you. What's driving this? We've talked about it briefly with Priya Misra. On the one side, you could say the market is very much on side with the views that are core of the Federal Reserve. Inflation and that higher rate of inflation will be transitory. Therefore, curve should be a little bit flatter, break-evens off the highs from May, all of that good stuff. OK. The other explanation is this market is starting to believe and question the flexible average inflation targeting of this Federal Reserve, the very reaction function that they've worked on over the last year. The belief, perhaps, that with a inflationary read on growth, like the ISM yesterday, there is a belief now that the Fed steps in a little bit too early and chokes things off. Priya Misra of TD, on a little bit earlier, making that point. She thinks it's the wrong way to go. And, Tom, that's why she's looking for a steeper curve and 10s out to 2 by year end.
OK, that may be. I'm going to go with Deutsche Bank here and the two-part yield market they see and economy they see, which is a short-term dynamic. And they're also looking at the long-term dynamic, which affects that 30-year bond. What are we going to see a 199 at 8:32 this morning?
We'll find out at 8:32. We will. Should we get there, Tom? Who would have thought? Who would have thought that Lisa would go to Greece, that Kaylee would go to Greece, and they'd be on the same plane, TK?
I mean,
the same flight.
It's it's against surveillance policy. There's too much risk there.
The only thing we know so far this morning is that Lisa is not going to Crete, and Kaylee is not going to Crete. That's all we know.
That's all we know.
But they're on the same flight. I won't ask you which airport. We do respect your privacy. Kaylee Lyons, good morning. Hey, Kaylee.
Good morning, John. Lisa and I are going to have a great time at the airport bar later on tonight. But forget about commercial flight. Let's talk space flight. Richard Branson is going up to space on a Virgin Galactic test flight on July 11th. And when is that? It is 9 days before Jeff Bezos. He's beating him to the punch here. As a result, space ticker shares are up by about 28% in early hours. And of course, Lisa and I are allowed to go to Greece because we're vaccinated Americans. It's not necessarily the reverse. But speaking of vaccines, Johnson & Johnson saying that theirs protects you against the Delta variant. That stock is higher today. CureVac, though, not having as much success with its vaccine. Those shares are lower. And then I also wanted to point to Intelia Therapeutics. This is about gene editing. It saw a really nice boost on Wednesday. Today, though, it is just fractionally higher, up about 0.4%. And of course, it has also been a really busy week for IPOs. I wanted to check on how some of those newly listed stocks are doing. One of them is pop culture group. This is a Chinese hip hop producer. Tom, I know hip hop is your absolute favorite music genre. This is an insane story. It IPO'd at $6 a share, spiked 405% in its debut, then doubled again yesterday. So this morning it is trading at $67 a share. You do have Didi, another Chinese listed company listing here in the U.S. It actually didn't have a great debut, then rallied yesterday. Today, though, slightly lower. Xometry had a good debut. It is up. And then Krispy Kreme donuts. I have been outed on television this week as someone who has never had a donut. Apparently, maybe that is weighing on the minds of Krispy Kreme investors because it's lower this morning.
Kaylee, there's a real legacy on Krispy Kreme within Wall Street. And the first time they came around, it was hugely anticipated. If you had a hedge fund, prime brokers would offer you that you could short Krispy Kreme, and they would get you the stock to do that. And of course, this is a whole new iteration this time around. John and I Kaylee, we're just like, can I carry your suitcases? Kaylee Lyons, 10 a.m. this morning as well. Right now, moving forward here, economics. Sarah House, Wells Fargo here, of course, on what we're going to see today with the jobs report. Sarah, the great conundrum is the service sector. What is your partition this morning between good producing and service sector jobs?
Well, I think we'll definitely be looking at what's happening in the leisure and hospitality sector, since that's where you still have the biggest deficit between where we were back in February of 2020 and where we are today. And of course, that's the area with the biggest upside coming from reopening, the fact that people are again traveling again, even domestically as Lisa takes off. But as we look at the breakdown of what we're seeing, I think we'll still be paying very close attention to the good side of the economy too. So we did have a dip in construction last month. How much of that is also because of supply issues there, builders getting materials? And so I think there's going to be a lot to parse through in terms of whether we're seeing these supply constraints beginning to ease and whether workers are coming back. How much of it is a skills mismatch versus maybe just some hesitation?
Have you tweaked your non-farm payrolls number, and what's the direction of that adjustment?
So we're looking for a gain of 750,000 new jobs. And so that would suggest some momentum. So we didn't tweak after yesterday's ISM or ADP on Wednesday, but we do see signs that demand improved further over the past month. So you can see that with the continuation of job openings, the hiring plans numbers that came out for June from the NFIB survey yesterday. But importantly, we're also seeing at least some small signs of constraints beginning to ease. So less fears about getting COVID. We've seen as well drop in continuing claims, suggesting more people might be moving back to work as well. So we think together that stronger demand and easing supply constraints gives us some upward momentum in terms of the payroll numbers.
Sarah, I remember earlier this year, I think you had one of the quotes of the moment when you said, "No one said reopening would be cheap." That was your line. Is there anything you've been surprised by about how the data has come in, though?
I think it has been pretty surprising in terms of the wage number. So we've seen some big increases in average hourly earnings the past 2 months. And what's been remarkable is that's coming as we're seeing more jobs being added in the very low wage sectors, and really just how much employers are increasing pay. So yes, we're seeing a lot of signing bonuses, but the average hourly earnings numbers, that reflects that hourly pay. These are not this is not just a one-time pass off. These are going to be at least a permanently higher level of wages. It remains to be seen what happens to the pace of growth going forward. But we have had to see businesses really pony up for labor, and that's being reflected in some pretty massive gains in terms of that pay for leisure and hospitality, retail, trade and transportation, all those low pay sectors. Workers have been more hesitant to come back to them, and it's costing businesses more.
John, earlier today, Sarah was talking about the participation rate and how it hasn't come back to where it was, and it still remains far behind. I think more than 7 million Americans still out of work. When will we have a clearer sense of how much of this is more permanent in nature versus some of these other concerns, whether it's childcare or COVID, or even perhaps just taking advantage of enhanced unemployment benefits?
Right. So I think we're going to have to wait for the fall to see how much of this is just a timing mismatch where businesses have been ready to reopen faster than workers have been ready to come back, whether that's because, we've been told to stay away from other people for the past 15 months, or it is these childcare issues with school having been remote last year and needing to get back full-time in person to the classroom this fall. How much of it is perhaps those enhanced unemployment insurance? And so I think it's going to take, probably until October, maybe even November, after you get the October jobs report, that we're going to get a better sense of how much of that is just this timing issue, that it takes timing to rehire, it takes timing to line up your childcare, to find that new job where maybe you also want more of a career. So workers are rethinking what they want, versus how much of this is maybe some more longer term damage around, to the labor supply, retirements, different views of family considerations and how the degree to which parents come back.
Sarah, our focus this morning is the Greek islands. I mean, the distance from Corfu to Crete is 500 miles. I know you're an expert on Corfu as well. Did you find Corfu to be equivalent to Crete far to the south?
Having never been to Crete, can't quite compare it, but I think, but I'm jealous of Lisa and her travels next week. I'll be trying to get some research done myself. She deserves it.
She's not going to Crete either. Don't worry. Sarah House of Wells Fargo. Sarah, thank you. If you tuned in from outside of America, I think you might have guessed already. There's a long weekend coming up stateside. Tom, we've got to get to payrolls first.
Yeah, we do.
8:30.
I mean, we're an hour away from a really important report. Again, John, I'm going to look at wage dynamics because I'm really focused on the negative real wage, but also I'm going to take the 3-month moving average after those important revisions.
Sarah House is saying wait until the October payrolls report, Lisa, to figure some of this out.
Yes.
Yeah, but the Fed can't wait because at a certain point they have to start tapering and they have to give some indication. Otherwise, markets will predict what they're going to do for them and they'll have to disrupt the markets if they want to go against that. Really, I mean, you go, but right now the market is implying that they're going to make a policy error. And then, if they wait too long, they could get worried about runaway inflation.
Oh, so that's the side of the argument you'd come out on then? Because that's important, because there are two options here that we've been discussing all morning. Either some people do think exactly that, the Fed's going to come in early and choke off growth, or the market's quite well aligned with what the Federal Reserve and the core of the Fed are suggesting.
I would put out there that perhaps the Fed will go with what the market wants, because that's what it's done in the past.
Interesting. Lisa Abramowicz, Tom Keene, Jonathan Ferro, counting you down to payrolls at 8:30 Eastern Time. 720,000 is your median estimate. Right now, we stack up as follows. The scores look like this Friday morning. The S&P 500 advancing 4 points, up by almost 0.1% to 43 and close to 15. From New York City, up a little bit later, 8:30 Eastern Time. After that jobs report drops, we'll catch up with Jeff Rosenberg of BlackRock, a portfolio manager here in New York. From New York, this is Bloomberg.
With the First Word News, I'm Leanne Gerrans. OPEC and its allies are trying to resolve a dispute that is blocking measures to ease oil prices. A potential deal to increase production fell apart late yesterday. The United Arab Emirates is at odds with the cartel's leaders, Saudi Arabia and Russia. If efforts do fail today, the world may not get the extra oil supplies it was indeed expecting. Now, Johnson & Johnson has said its single-shot coronavirus vaccine neutralizes the fast-spreading Delta variant. The vaccine is also said to provide durable protection against infection more broadly. Delta is expected to become the dominant strain in the US in the coming weeks. Richard Branson plans to beat fellow billionaire Jeff Bezos into space. Branson will fly on a Virgin Galactic test flight on July the 11th, along with 5 others. That is just 9 days before Bezos plans a trip to space aboard a rocket made by his company, Blue Origin. He and the crew will be joined by 82-year-old Wally Funk. She was one of the first women to train for space flight, but never actually made it on to a mission. Global news, 24 hours a day. I'm Leanne Gerrans. This is Bloomberg.
The business is recovering very strongly. The two markets that are lagging that are clearly the UK and Ireland, where still there are travel restrictions, COVID restrictions still in place, and in my view, people overreacting to what the Delta variant, which has seen an upward spike in cases in the UK, but not any significant move in serious illnesses, hospitalizations or morbidity.
It is tough to run an airline right now. Michael O'Leary, the Ryanair CEO from New York City this morning. Good morning. Alongside Tom Keene, Lisa Abramowicz, I'm Jonathan Ferro, counting you down to the payrolls report in about 42 minutes' time. Here's the price action going into that. Equity futures up 4 on the S&P, 43.15, a 6-day winning streak into Friday, all-time highs on the S&P 500. Want to slice up this market just a little bit for you. Cross-asset yields down 2 basis points, 144. The grind lower continues. Yields are lower, the curve's flatter. But this is what I wanted to pick up on. Some news in the last 5 minutes. Get to Didi in the pre-market. This is the ride-hailing giant out of China. Closed its US trading debut a couple of days ago, raised $4.4 billion, and then bang, China launches a cybersecurity review of the company. They will halt registration of new users during the review. And this is according to a statement from Cyberspace Administration of China. And that stock, Tom, down in the pre-market by 5.5% to 15.50.
And not only that, but I'm going to suggest it maybe has a weight on the tape here. I mean, things have just softened up a little bit. I don't want to make a big deal about it. I don't want to associate it directly with Didi, John, but all of a sudden there's a little bit of a weight in the yield space, lower yields, and you wonder if it's Didi.
People will be asking this question, Tom. Is it just a coincidence that after a couple of days, after listing stateside, China has a big review?
Yeah, well, there it is. It's the back and forth that we see also with Russia. We've seen that recently as well. What we also see is a David Wilson chart on Jobs Day. That's important. What do you have?
Well, we're talking about what you'd call the dividend aristocrats. It's sort of a group of stocks, actually on both sides of the Atlantic, that Andrew Garthwaite over at Credit Suisse is recommending. And what the chart does, it focuses on the U.S. piece of it. There's an S&P 500 Dividend Aristocrats Index. So if you get into that indicator, you've raised your payouts every year for at least 25 years. So we're talking about a real track record of rewarding shareholders.
Yeah, you are expert at this, David Wilson. You're not going to toot your own horn, so I'm going to do it for you. You've written books about this in article after article. Have the dividend aristocrats changed because of the effort to buy back shares?
Well, I mean, they've shifted to some extent, but you have to remember some of the biggest technology companies, the ones, with cash flow, I mean, they're just not making payouts. Think about Google's owner, Alphabet. Think about Amazon.com, those kinds of companies. So the shift is not as extreme as it could be. Mm-hmm. One thing that has shifted, though, is the relationship between these aristocrats and the S&P 500 when it comes to dividends. You look at the aristocrat index, 2.3%. Doesn't sound like a lot, but that's a full percentage point more than what you're getting on the S&P 500 these days as the dividend yield has come down.
Very good. David Wilson, I have to leave it there as we wander up to Lenox, Massachusetts. It is the Boston Pops, and this year a different Boston Pops. They travel to their hallowed ground. It is no question the most historic summer place in America for classical music. Our Romaine Bostick is at the Shed. Romaine, it was the final concert of Leonard Bernstein, among other things, built in 1938, and you will grace its presence this weekend.
Yeah, I'm really honored to be here. Of course, I am in the Shed. This is the summer home of the Boston Pops. This is their venue, Tanglewood. Of course, on that stage behind me, Tom, in just a couple of days, we're going to have a real star-studded event here. Of course, Mavis Staples, legendary soul singer, and of course, John Batiste, just sort of a new breed of singer out there, jazz, the standards, and everything in between. They're going to be on that stage, of course, under the helm of Keith Lockhart, the conductor of the Boston Pops here. A big celebration here of our nation's independence, but also, Tom, it's a real celebration, too, of our reopening. This is going to be the first major event here at Tanglewood since the pandemic shut everything down. So there's a lot of excitement here. A lot of people really want to get out. They want to be, of course, with their fellow Americans and really just come out here and celebrate and have fun on Sunday.
Romaine, that's exactly where I wanted to go. The reopening of America, this idea of the end of the pandemic. What will it look like? What kind of measures will be taken that still recognize that the pandemic has not yet really gone away?
Well, there are still going to be some social distance measures in place here. Total capacity that it's going to be allowed is about 9,000 people, both here in the shed as well as out on the lawn, just off camera here. That's less than what you would normally have at full capacity here at Tanglewood. So there will be a lot of precautions in place here. However, we should point out we are sort of moving, at least hopefully, towards the end of this pandemic. And the folks who run this place and the folks who run a lot of the venues here in the Boston area and Lenox, Massachusetts area have said they are eager that hopefully by the end of the summer into the fall, a lot of these restrictions will be gone, hopefully by then.
We hope so. Romain, it's good to see you. Enjoy the long weekend, won't you? A lot of work for you too. Romain Bostic there. Bloomberg Markets, the close anchor. And tune in to the Boston Pops, July 4th Spectacular this Sunday at 8 p.m. Eastern Time on Bloomberg TV, radio.com, and of course on Quick Take too. Before we get there, before your weekend starts, we've got to deal with the Payrolls report in the United States of America. And going into that, we're looking for 720,000, Tom. That is your estimate going into this number.
And the revisions, as I said, important, John. I'm going to go to the most important chart. We're not going to show it because of radio. Lisa showed it yesterday. John, claims is not related. Thursday claims is not related really to what we're going to see today. But I'm sorry, it is a persistently constructive and optimistic chart. Maybe that's what we see over the next 90 days.
The direction of travel is important, and we need to see that persistence, that continue, Lisa, that improvement, and get better and better from here.
Pace and composition are two really important characteristics here, because it's definitely the pace. How long can we keep this up? And also the composition. I mean, I really go back to what Carl Riccidona was saying. How much momentum is there under the hood? How much of the job losses has been a result of some of the key areas of the economy, like leisure, going dark, versus some real lagging effects in the rest of the areas and the rest of the industries? And this is really something that needs to be dug into.
Well, let's talk about something that hasn't improved over the last 6 months or so. The participation rate in America hasn't really improved. Therefore, the employment to population rate in America has not really improved either. They're two of the things that we know. We know, Lisa, that officials on this Federal Reserve are focused on. That is driving policy.
And the key is, when do we know how much is scarring, how much is more permanent in nature versus just sort of a reopening effect, a lag time with people perhaps staying out because of illness fears or because of their kids. These are really unknowns at this point. And John, we have to also emphasize there's been a huge technological shift underpinning this recent year. I mean, the idea of the move to the cloud, the move to remote work. How much does this shift the skills that are required for some of these individuals?
So is it structural or is it cyclical? And the answer to that question, Tom, tells you how much the Fed can do about it in the coming months and years.
Yeah, I'm not really focused on structural and cyclical, John. I think there's so much noise out there. Who can split the two apart? I just think we stagger day by day. Look at the IMF numbers pulling up to some extraordinary numbers. And again, I'm going to go back, John, to the immediate data. And to me, the beginning of the earnings season, frankly, it's as important as this jobs report.
Well, and honestly, John, though, this is the real key point. At what point is the Fed not helping anything with their policies? To your point, how much is this structural and needs other kinds of remedies? And that, I think, is a really important question.
A conversation through the next couple of hours on Bloomberg TV and radio. Jill Carey-Hall of Bank of America on the equity market. And then we'll catch up with the Labour Secretary a little bit later this morning following the jobs report. We'll do that at around 9:30, 9:45 Eastern Time. From New York, on radio, on TV, on this Payrolls Friday, thank you for choosing Bloomberg.
We see a very high number of people who are quitting their jobs. We only see that when people feel very confident about the job market.
I think consumers have money in their pocket, and we're going to have a super holiday season.
I do think we're far enough along that a lot of that scarring should begin to dissipate.
Clearly, we're heading towards an environment where they have to consider tapering.
I would argue every data point now is going to be a market event because they've put the market on notice.
This is Bloomberg Surveillance with Tom Keene, Jonathan Ferro, and Lisa Abramowicz.
Good morning, everyone. Jonathan Ferro, Lisa Abramowicz, and Tom Keene. Jobs Day in America. We are focused on 30 minutes from now, an update on the American labor economy. And you have to fold it, John, into all of this boom American economy.
And a boom equity market too, Tom. 43.15 in the equity market. all-time highs, up another 1/10%. Bond market, that's what gets my attention. Yields lower, curve flatter over the last couple of weeks. Right now, 144 going into this jobs report, 29 minutes away.
Let's do this different now. We're going to go right now into why we're seeing flattening. The two of you. John, why do we see flattening right now in the yield curve?
I'll give you the range of options. Right now, there are two. Either this market is well in line with the core of the Federal Reserve and believes that inflation is transitory, or this market and some market participants are starting to position for a Fed that they think will choke off growth and inflation early. Maybe that would explain the flatter curve. Priya Misra of TD thinks it's the latter and not the former.
Lisa, to me, it's also the secondary effect of the great build, like 2006, price up, and yield in on IG and high yield.
Yeah, well, you could see that, but there are two different stories here. The credit market pricing
really?
in.
You think so?
I do think so. I mean, to some degree, there is a separation between credit and full faith in credit. Full faith in the United States backing their debts. This idea here of a good economy is better for companies that are more leveraged. On the flip side, government debt you don't want to own if you have a really rapid growth, if you expect inflation. What I'm looking out, though, is, frankly, people who are acknowledging that nothing structurally has changed over the pandemic to lead to a higher inflationary rate. And that, I think, is one message that's loud and clear. I am wondering about those real yields, though. When are people going to start worrying about supply and demand if the Fed starts to move away from
so glad you bring that up. A negative 0.91, a much lower, greater negative statistic on the real yield. Of course, summed this afternoon by Jonathan Ferro, who's not going to Greece. He'll have that on the real yield here in the afternoon. We've got all sorts of people watching today. We thank some government officials for watching. We'll get to that in a moment, and academics as well. But, John, I think we need to get to the data check right now to get to the conversation into this jobs report. John, green on the screen, and the VIX 15.14 near a 14 handle.
43.16 on the S&P. We shape up as follows on the S&P. Coming into Friday, 6 days of gains. Can we make it 7? Up 6 points. We advanced by 0.13%. We've talked about the bond market through the morning. 144 is your yield on a 10-year. We come in 2 basis points. Crude got your attention yesterday. It does not this morning. 74.81. We're down by 0.6% there. And Tom, you mentioned it a couple of hours ago. Dollar stronger, euro weaker. Yeah. That currency pair, negative 0.25%. Euro dollar 118.22.
A 118.22 is a huge deal. A 117 print would confirm Japanese weakness that we see as well. A 111.43 on dollar yen. Let's jump to it now and get to the conversation in a moment. Jill Carey-Hall with Bank of America, looking at the equity markets as senior U.S. equity strategist. Jill, what did you tweak at mid-year, waiting for this jobs report, to adjust to the earnings season that comes?
Well, look, I think one of the important parts of the jobs report will be the wage data, and questions persist as to how transitory the inflation backdrop is going to be. You know, we've seen companies this past earnings season have their margins hold up very well, given the inflation pressures that we've seen. So I think that'll be, one of the key factors to watch for the coming earnings season. And, that was one of the reasons that, given the stronger wage data that we've seen, we lowered industrials from an overweight view to a market weight view. It's the second most labor intensive sector after consumer discretionary, which we had also recently downgraded to an underweight view. So these sectors have a higher ratio of employees relative to sales. So there's more margin risk if we continue to see wage inflation rise.
Jill, I know you're bullish on the cyclical parts of this market outside of industrials. I want to talk about your index level price target just for a moment, though. You and a team, along with Savita, the most bearish on the street right now at 3,800 year end. We're at 4,300 right now. What do you think is going to take us back down to those kind of levels?
Well, look, we do think the market will end the year lower than the levels that it's at today. And I think one of the reasons is just the euphoric equity sentiment that we've seen. Our measure of Wall Street equity sentiment, even though it took a bit of a breather this past month, is still, at levels that we have not seen in many years. So, equity allocations, recommended equity allocations have been rising. Valuations are obviously extended. So obviously from a sentiment and valuation perspective, we don't see much upside here to the market. And we really think that the rest of this year will be more about investing in those rotations within the market. And that's where we continue to prefer value over growth, where, given the tilt of the S&P 500 toward a lot of those, big mega cap growth stocks, that continued rotation to value is actually something that can cause, the market to go down rather than up.
Jill, I want to just sit on what you just said for a minute. The sell side indicator reaching its most strong sell signal since the great financial crisis, as you pointed out in your note. What is the precedent in previous times in history? Maybe the great financial crisis is one, but other times that you think are important to look at, to reflect in terms of positioning and views for possibly giving some guide for how quickly the market could turn?
Yeah, so we survey other Wall Street strategists about what they're recommending that investors put into equities in a balanced fund. And that indicator, while it's still in neutral territory, it's less than a percentage point away from a sell signal, as you mentioned. When Wall Street strategists altogether are super bullish, that tends to be a contrarian negative signal to do the opposite and sell equities. So, we've been in an environment where equity allocations were secularly lower post the financial crisis. But, this indicator is at highest level, closest to a sell signal that we've seen since 2007. So, as I mentioned, I think we'd be more cautious on the market overall, but we would rotate into some of the styles that I've been mentioning, and quality is another one. I think that if we see earnings peak out in the fourth quarter of 2021 on a trailing basis, if we see peak stimulus, these are supportive of high quality stocks, which should start to outperform low quality stocks, but right now are trading at a discount.
Mm-hmm. Joe, I'm absolutely fascinated how you're constructing your earnings guess for next year. Do you have a real belief in it, or you just have to simply wait to the beginning of earnings season, July 13th?
So this year we're expecting over 30% earnings growth in 2021, and then that'll slow to about 11% in 2022. Obviously, given the super strong beat that we saw in the first quarter, there could be upside to this year. But for next year, there's some potential downside risk if we were to see tax reform, which could have kind of a mid-single digit impact to S&P 500 earnings, obviously depending on where the corporate tax rate goes. But that, higher taxes could put some of the sectors like tech at risk that could be targeted from some of the tax reform proposals. So, I think, as I mentioned, inflation and wages will be important to watch for, to look at the margin outlook as we come up into the second quarter earnings. And then beyond that, I think tax reform will be an important thing to watch as well.
Jill, it is Payrolls Friday. We'll get the report in about 22 minutes' time. You and the team have done some really nice work on jobs intensity in some of this market. Just how jobs intensive is the equity market, the S&P 500, and how's that shaped up over the last several decades?
Yeah, so, even though, as I mentioned, we are watching the wage inflation data closely, the labor intensity of the S&P 500, the good news there is that the index is a lot less labor intensive than it was multiple decades ago. So when you look at that ratio of employees relative to sales that is produced by companies within the index, it's about 70% lower than we were tracking about 30 years ago. So more labor light, and certainly, you have bigger areas like tech within the index, but the areas that we would watch that are the more labor intensive areas are parts of the industrial sector, parts of the consumer discretionary sector, so areas like hotels and restaurants and some traditional retailers that hire a lot of people and could see margins at risk.
Jill, really smart, and always appreciate your time. Send our best to the team, won't you? Jill Carey-Hall of Bank of America. And Lisa, the labour intensity of this market is something we're all increasingly focused on as we look for payrolls in 20 minutes.
And I keep thinking about the participation rate as part of that. I mean, if people are funneling more capital to companies that can automate or don't need as many people as other companies, what does that say in terms of access to capital, in terms of the direction of the economy? I mean, it just sort of goes to this idea of a structural shift that we're seeing bear out in employment.
There's a really tidy ratio for this that Bank of America have done the work on, Tom, the employee to revenue ratio. And to put it simply, over the last several decades, it's headed south. It's been heading south. Why? Just take a look at some of these tech firms and just do a DES on the Bloomberg screen and have a look at how many employees they have compared to, say, the companies
Ford
of
Motor.
yesteryear.
Yeah, there's no question. I mean, the dynamics have changed, John, and sure, there's the boom in employment at Amazon. We all understand that, and some of these others. But the tech has just changed the labor share so much. John, it's just a joy to have an international audience. I mean, you've been so part of building that out.
Thanks, Tom.
Well, the Prime Minister of Greece has taken note of our show this morning. He's from one of the most esteemed families of Greece. His ancestors back in 1910 literally kept Greece on the side of the Allies in World War I, and we are honored that the Prime Minister's office notes that Lisa is not going to Crete.
Lisa won't be going to Crete. Just for the record, Prime Minister Mitsotakis promised us an interview, Tom, in Mykonos. Do you remember that?
Yeah, I do.
We had that conversation.
We
that
did
was
have that
confirmed.
conversation.
Is that right? When?
I'm still waiting for the follow-up from the PM's office.
Well, we're looking for the PM.
Maybe we should do that next week, Tom.
I think
maybe we should do that next week.
It says October as well. You know, or
could you imagine if we took a studio and just set up on the beach that Lisa was on?
Well, it's important though. I mean, it's one symbol that things are open, right?
I agree.
Things are open.
A symbol of something, Tom.
I agree, TK. I'm looking forward to that. Okay, let's get it set up. 19 minutes away from the opening bell. 19 minutes away from the jobs report. Add an hour for the opening bell.
Not Crete.
Yields are down a basis point.
Athens. I know that.
144 on 10s. 43.14 on the S&P. Your jobs report. 20 minutes away from New York City. Heard on radio, seen on TV.
What's the unemployment rate on Crete?
This is Bloomberg.
With the First Word News, I'm Leanne Gerrans. The OPEC Plus coalition is trying to find a way out of a standoff that is blocking an increase in oil supply. One of the cartel's key members, the United Arab Emirates, is at odds with Saudi Arabia and Russia. If the dispute cannot be resolved, that could mean the global economy won't get the extra oil it was counting on, and that could lead to higher prices. Now, London is once again Europe's largest share trading centre. The city moved back ahead of Amsterdam in June. It's the first time this year London's been on top. Brexit pushed much of the city's volumes to the continent. Paris was the third largest venue. Now, Charles Schwab will take a $200 million charge in the second quarter linked to an SEC investigation. The inquiry relates to disclosures around the firm's Schwab Intelligent Portfolios product. Schwab purchased rival brokerage TD Ameritrade in October. That gave America's original discount broker even more influence over the industry it pioneered nearly half a century ago. A group of Republican senators wants President Biden to end the trade war initiated by Donald Trump. The 7 lawmakers wrote to the president asking him to revoke tariffs and other barriers imposed on China and European allies. They referred to the trade war as self-inflicted harm. Global news 24 hours a day on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Leanne Gerrans. This is Bloomberg.
Romaine Bostic here, live from Tanglewood. In just a couple of days, on that stage behind me, the Boston Pops July 4th Spectacular. Mavis Staples, John Baptiste, they're going to be performing on that stage. The 6-string soldiers of the U.S. Army Field Band, the singing sergeants, of course, of our very own United States Air Force, all under the direction of our conductor, Keith Lockhart. The Boston Pops July 4th Spectacular. You don't want to miss it. It's going to be at 8 p.m. on Sunday, right here on Bloomberg.
Certainly, we have seen large consumer price movements in recent months, and we think that those fairly high inflation readings will continue for a few months. I want to emphasize, however, that the evidence suggests that this inflation will be transitory, and it is largely a product of relative price movements that are occurring as the economy rebounds.
That was Kristalina Georgieva there, the IMF Managing Director on the U.S. economy. Bullish the U.S. economy this year and next over at the IMF. From New York, this is Bloomberg. Alongside Tom Keene, Lisa Abramowicz, I'm Jonathan Ferro. We are 12 minutes away, call it 11, from the jobs report in America. Going into that, Here's the price action. Equity futures are drifting higher again, up 4-5 points. We advance 0.1%. 6-day winning streak into Friday. All-time highs. The jobs report 11 minutes away. 720K is what the estimate is right now. The median estimate in our Bloomberg survey. Yields are lower into this print. We're down 2 basis points, Tom, to 144.
Fascinating tape. It's not a fragile tape, but it's just a very tentative tape here into 8:30. And again, that's in 10 minutes. As he always does, he provides perspective, but frankly, never more so than right now. James Glassman, he was at J.P. Morgan Chase Commercial Banking, and he's been definitive in his research on the labor economy for years and on the many help-wanted signs coast to coast. Jim, I was just away on a sojourn. It's not as romantic as Lisa going to Greece. I went up to Maine and had a lobster. And Jim Glassman, what I would note is there's a different character to the help-wanted signs. What's the desperation across America to find the next employee?
You know, it's interesting, isn't it? They're pretty desperate, and I think the problem for them is that if you can't find the people, as you've been hearing, they just can't serve as many people. So it's lost opportunity. But I think it takes, you know, this was really a massive dislocations that were caused by the pandemic, and it's just going to take. My guess is it's going to take until the fall. You get a lot of this ironed out, and you know, when you if you don't have a job and maybe you're on unemployment, you can't really live in the city that long. They might have scattered and went home to family. Now they are be coming back, and I think by the early fall we're not going to hear about this, but it is a concern, and you hear it every. What's in short supply is help-wanted signs.
But Jim Glassman, very, very importantly here, if wages went up, are there employees there to accept those jobs?
Well, I don't think that would really solve the issue. I think it's really more all the dislocations. And the problem for a business is they got to ask themselves, can we absorb this? If we have to pay people, well, right now you're hearing about one-time bonuses. But if you have to raise the pay significantly, will the customer bear it? That's what they're having to deal with. And I think for a lot of people who are in a global world, competing globally, this is they have to be really careful about this.
Well, yeah, and just to point that out, I mean, Tom went up to Maine, and he said he just went there, but he did buy a lobster roll for $40, talking about prices going up. Jim, there is a question of what data you're looking at that determines the stickiness of those wage increases. What are you looking for?
I think the wage information is not going to be that helpful, frankly, because a lot of the folks who are still out of work are, say, earning below the average. So as they come back in, you're going to have pay trends looking like they're slowing down. The employment cost index is usually the best indicator for this kind of thing, because when you have lots of changes going on in the economy, they do a better job of fixating on the changing composition of the economy. But, you know, honestly, I don't worry. To me, this is not an inflation story. If we have to pay more for workers, this is not going to. This is not something that creates inflation. This is what we used to think. This is the old days. This has not been happening. We have noticed over the last several decades, pay trends have been doing better than they used to. They're keeping up with productivity, at least in real terms, and that's a good thing. But what we've learned over the last 2 decades is inflation doesn't come from paying workers. It comes from how good are your markets, how much competition do you have, what's going on with technology. And so I think this recent round of worry about inflation is really all connected to the bottlenecks in the supply chain, and a lot of these are easing now. If you look at futures prices, you're seeing some of this noise is fading back.
Jim, we've got to leave it there. It's good to catch up, as always. Jim Glassman, J.P. Morgan Chase, commercial banking head economist. Going into payrolls in about 7 minutes' time. We've talked about this massive range into the print, Tom, all the way from 720, that's your median, to 1050 at the upper end, of 400K at the low end.
Yeah, well, I mean, the numbers are there. And up we go, and we're going to see it. But, John, again, I'm going to wages and revisions. And what are you going to look for, John? I mean, what beneath the headline data is the point you're going to look at?
Participation rate, I think, Tom.
Okay.
Because it has absolutely stalled through the whole of this year.
And it's nowhere near where it was February of 2020.
And how quickly that bounces back goes some way, I think, to shaping Fed policy.
No, we'll have to see. I mean, Lisa, what do you see there?
Well, the idea here is what are the factors that are keeping people out of the labor market? Is it simply a transitory issue of childcare and virus and enhanced unemployment benefits compensating people? Or is there a stickier kind of persistence to this lack of participation? It's a good question. And it kind of goes to Carl Riccidona's point about which areas of the market are adding jobs fastest versus not seeing the same momentum.
And participation rate, Tom. For me, the key variable, because that will define basically how quickly unemployment falls and how quickly wages rise.
Well, yeah,
bottom line.
Yeah, and again, and John, the good idea of look at the participation rate in these different ratios is to look at the ratios of actual employed, and I'm going to look in the middle of the band. I'm guessing 25 to 54 years old, that hugely employable America, that dynamic as well.
Look at that employment to population ratio, Lisa. It's just another way of telling the same story. We had this sharp improvement as we reopened, and then we flattened out again. And Fed official after Fed official, especially the Doves, in fact, the Doves over on the FOMC, they're making the point that they want to see that get back to where it was.
Well, but you raised this question, and I think it's a really important one. How much does the Fed affect that? At what point is this structural? And Jill Carey Hall was talking about how people are looking to companies that don't employ as many people. Well, that is the shift. How efficient can you be as an employer? So are there going to be the jobs that make people's pay worthwhile going forward, especially as things get more automated? I mean, this seems like a big picture issue, but it was accelerated, John, by what we saw during the pandemic and this shift to online everything.
Yeah, well, there's a calendar issue at play here, Tom, as well. And you will see guest after guest come on this program and keep talking about the end of summer, September, October, to iron out some of these issues. Can we just solve them, address them?
More data.
Just simply with time, with the calendar.
I'm looking at moving averages. The data's been so lumpy, I got to go to 3 months moving average.
The jobs report up next on Bloomberg TV and radio. We are 4.5 minutes away. Your estimate is 720K. The high end 1050, the low end 400. After a couple of downside surprises over the last couple of months, what is in store? The answer to that question comes up next. 43.15 on the S&P, 144 on 10s. Yields are lower, the equity market's higher going into this one. The jobs report's next. This is Bloomberg. From New York City, live on TV and radio for our audience worldwide. Going into this jobs print, seconds away, equities higher, yields are lower, the curve is flatter. With your jobs report in America, here's Mike McKee.
Well, we get more jobs than expected, John, for the first time in a couple of months. 850,000 jobs restored in the month of June. The 2-month net payroll revision, 15,000. So you can add another 15,000 to the 850, come up with 865. Change in private payrolls, 662,000. Manufacturing up by 15,000. There was some question about that yesterday when the ISM report showed contraction in hiring, but that may be because the manufacturers couldn't find workers. The unemployment rate goes up to 5.9%, and I've got to double check, but I think that is because we see a rise in the labor force. The number of people in the labor force goes up by 151,000. So yes, that is an issue. No change in the participation rate, 61.6%. The employment to population ratio is also unchanged at 58. So it looks like we are attracting more people into the labor force, which pushes the unemployment rate a little bit higher. It's one of those things where you say it's good news that the unemployment rate goes up. Average hourly earnings, 3.6%, bang on with forecasts. Last month, it was 1.9%. That's the year-over-year number. So all in all, it looks like a pretty good jobs report, a little bit better than expected in most categories, and the unemployment rate is something you can look past.
Mike, keep going through it. I'll go through the price action. A lift in the equity market. We advanced by 0.2%, add a little bit more weight to the S&P 500. Out to the bond market. Let's slice it up. 2s out to 10s. 2-year yield higher by about a basis point. We fade the long end move just a little bit on 10s. Yields are in about a basis point. On 30s, that sticks. We're down by 2 basis points on a 30-year to 2.042%. Tom, that's the shape of things coming out of this in the bond market and in equities. Struggle to read this one to get a clear direction on what this means for a Fed meeting through the next several months.
I'm going to call equity lift, and what I'm really looking at, John, is DXY went stronger right away and then ebbed in a little bit. Mike McKeith, totally unfair question, but it's Unfair Friday. How does this change Fed policy? And the answer is, as John says, we're not seeing much on the screen.
No, it doesn't change Fed policy, and you're not going to see much reaction in the markets. If you get some reaction, it's probably going to be because it's a low volume day with an early close before a holiday weekend. At this point, this just tells you that we're headed in the right direction. And I was discussing this last night with somebody, and they said, how do you read this number? And I would say, you put it in the context of what Jay Powell has said, that you're looking for substantial further improvement in their goals before they start tapering. And this keeps you moving in that direction. Beyond that, you can't say a whole lot about Fed policy.
If we do 700,000 and we do it over 10 months, that's 7 million jobs created. Is that how you mop up our not fully employed America?
Well, yes, and you hope that you get a little bit faster rate of employment absorption. And the feeling is that we may get more of that come the fall when you have kids go back to school, so child care responsibilities aren't as heavy, and when all states are no longer paying supplemental unemployment benefits.
Lisa, the dollar turns around and weakens right now.
The question I have is how much momentum is there in the broad economy? How much is this isolated to restaurants and bars that are reopening now? Do you have a sense of that, Mike?
Well, I can give you a number on that. The leisure and hospitality group increased by 343,000. 194,000 of those, almost half, is in restaurants and bars. Now, that's lower than last month, but we are seeing the states reopen, and so people are going back to work. But one would imagine there are still shortages in that area of available workers because it didn't rise nearly as much as the month before. The other issue is government education, and this may be something we have to look into, the seasonals issue, because the seasonals expect that you will see a lot of layoffs in government, state and local government education, but this month we added 75,000 at the state level, 39,000 at the local level, because probably people weren't working because the schools were closed in many cases, and so the seasonals anticipate the wrong thing. So again, it kind of goes back to the issue of this is the exact numbers don't give you much to go on other than the general feeling that we're going in the right direction. I think Kit Jukes put it best today when he said this is going to be more like an abstract painting than a realistic one.
Well, I like that. An abstract painting as well as we move forward with the equity markets. Futures up 12, Dow futures up 72. The VIX comes in very nicely. That's important from a 15 level in 0.71 points to 1477. Jeffrey Rosenberg doesn't care about the VIX. He's at BlackRock, portfolio manager of their systematic multi-strategy fund, and he is systematically seeing curve flattening the last number of days, perhaps with a view to this jobs report. Jeff Rosenberg, let's start right away with a linkage of a better American employment to a flattening yield curve. Why?
Yeah, that's a great point, Tom. That was what I was going to highlight. Interesting market reaction. Initially, you certainly saw that flattening. It's continuing here. The report is pretty much on the screws in terms of market expectations. I think Mike hit the kind of surprising piece right on the head with the unemployment rate higher. Good news, reflection of more people coming back into the labor market. The positive report in the curve flattening, it reminds me of what we saw after the FOMC, which is that the good news brings forward the idea of earlier possible increases in interest rates. We saw that after the dot plot, and I think you're seeing a little bit of market reaction on that again here. I wouldn't overstate it. It's these are small moves, but if we're looking for some kind of message, it's that continued progress on the reopening, on the strength of the economy, is raising expectations here that the Fed's going to raise rates perhaps faster than what the market had been pricing in, and that's getting you to a curve flattening where the bulk of the increases in the front end of the curve, and then longer term interest rates, which have already priced in a fair amount of relative value, potentially signaling here that that's going to, look through to the slowdown after the surge of the economic activity passes from the fiscal stimulus. So I think that's what the curve flattening is, kind of the main message from the markets today.
It's tough to be in this bond market right now, Jeff. Q1 is where we saw the peak of the 10-year yield at the end of March. It's where the yield curve peaked too, and we saw break-evens peak potentially back in May. So the curve is flatter, and we've had calls on this program of 10s getting back to 2%, Jeff. How difficult would it be for 10s to get back to 2%?
Well, that would be a pretty significant reversal. I think you're highlighting really the important point that we peaked in terms of the reflationary narrative. There was kind of a double peak. There was a March, then it kind of flattened out, and then mid-May we saw it again. And in that period, since then, we've basically been pushing downward this reflation narrative out of the bond market. And it's really quite notable. The longer end forwards have been falling. As you mentioned, inflation expectations, outside of kind of the impact of energy, really stopped rising. And it's a reflection of kind of buy the rumor, sell the news. That is, the markets were moving well ahead of the economic data. The economic data has kind of borne that out, but without kind of the breakout of the inflation outside of this transitory story. Look at something that came out earlier this week, the Dallas trimmed mean measures of inflation. They're continuing to basically show that the story of transitory inflation is holding up. And so you can't really get further curve steepening, further inflation expectations until we see, what we're seeing in some of the survey data, the price pressures building, pass through into a broader array of prices outside of the pandemic-related stories that we've heard so much about. That's still, going to be the future. And until then, the curves are and market pricing are really starting to price out some of this reflation story.
I will say in the last couple of minutes, we've faded some of that flattening in the Treasury curve, just a little bit, particularly at the long end. We've given some of that move up. For people just tuning in, it's an upside surprise. 850K, the median estimate was 720. That's what we want to see. Wages, 3.6%, in line with expectations, a pickup from the previous month. That is what we want to see. In your equity market, if you're bullish, this is what you want to see. Another 10 points higher on the S&P, potentially a seventh day of gains. The S&P 500, 43.20. We'll continue this conversation live on TV and radio in about 20 minutes' time. I'll head over to a different studio and catch up with Rick Reeder of BlackRock alongside Mohammed Al-Arian. Of course, our jobs lineup is always stellar in the 9 o'clock in the open. And then we'll catch up with Secretary Walsh, the Labour Secretary, live on TV and radio in the next hour, Tom.
Very good. Look forward to that. There's a lot to talk about here, to say the least. Jeff Rosenberg, I got 3.12 million jobs. That's with revisions, formed in 2001. That's a slow motion path to 10, 11, 12 million jobs to fully employed America. How does BlackRock frame the goal of fully employed America to all the summer emotions of Fed policy, taper tantrum, Jackson Hole, and what the yield market does? I mean, how do you frame that out, that x-axis?
Yeah, the key is that the Fed has kind of moved its dual objectives towards more favoring of the employment objective relative to the inflation expectations and the inflation objective. And so while in past cycles, this kind of full employment might have led to preemptive Fed tightening, the movement towards flexible average inflation targeting is really a wholesale change in how the market reacts to the payroll figures with respect to interest rate expectations. Now, that doesn't mean that they're never going to raise interest rates, and that's part of the earlier conversation of what followed at the dots. But what it means is that the way we hung on every payroll report is not quite the same as it was when we were kind of growing up. And that's because we've missed on inflation for so long that the Fed is really focused on achieving its inflation target. And they're not going to jump the gun when it comes to full employment. They're going to let the labor market run hot. And today is another piece of evidence that that's working, that strategy is working, the labor market is improving, and that's what they want to see. The risk, of course, what everybody's worried about is what happens if you let the inflation genie out of the bottle. And Powell and the Fed policymakers have been very clear that they're willing to take that risk because the last 10 years, the post-global financial crisis, they've missed on inflation. Inflation's been too low. So we've tilted the axes here, and it's an important change when we read the payroll reports.
Jeff, that's what the Fed says, that they are willing to look past near-term inflation, that they want this economy to run hot, that they are not that concerned about runaway inflation. Is your message from the market that the market doesn't believe them? Because they believe still, as Priya Misra was saying, at least priced in, and that is sort of the flattening in the yield curve, that there will be a policy error, that they will taper and then hike rates too soon. Is the market misreading what the Fed is saying?
You know, I can understand how a little bit you might interpret the yield curve flattening that way. That I think it would overstate how much of a concern there is right now on the policy error of too fast of tightening. I think right now, mostly the read from the market is that they price in the transitory story. And perhaps the market got a little ahead of itself when it came to the reflationary story. You've got some technicals and trading and momentum strategies, and that's a little bit behind the flattening as well. But mostly when you look at kind of longer term forward prices of inflation expectations, they're kind of right on the screws of the transitory story, just above 2%. And I think so far that's been, validated by the data. Still to be seen long term whether it will be, but that's where the markets are at now.
Jeff Rosenberg, thank you so much with BlackRock this morning. The market's really moving here. Some of the nuance here, no doubt thinking of what Mike McKee's thinking, because what he does is he comes on and he gives us a report, and then he actually digests the pages and pages of data. And Mike McKee, the market's doing the same thing, and the market goes the other way with curve steepening. And equities on a tear, futures up 12.
Yeah, it's a sort of a report that tells you that things are getting better, but they're not getting better at a hugely improved pace. One of the things the Fed's been looking at is minority unemployment, and we're looking at employment of Black Americans is at 9.2%. That's a tick up. Hispanic Americans, 7.4%. That's a tick up. So they follow the general unemployment rate a little bit higher. So not as much improvement there, but more jobs created than expected. And that's good because over the longer run, we're heading in the right direction. Average weekly hours dropped to 34.7 from 34.8, a revised 34.8. And that's a bit of a problem because it takes earnings out of the economy, the money that you would have earned for those extra hours. So we got to keep an eye on that as well.
Michael McKee, I want to go to that point that you raised initially, the idea that the unemployment rate actually ticked higher as more people came back into the labor market. Do we have a sense of what the character of those entrants, or those re-entrants, I should say, was, what jobs they were going to, and how quickly those people are starting to reemerge and look for work?
Well, the biggest hiring was in the leisure and hospitality area, and also in retail rising, services rising, and it does show that the lower end is coming back. Some of those jobs are getting filled. But a closer look at the household data does suggest that it wasn't as good as it seems, the idea that more people came into the labor force, because what we saw was an actual decline in employment in the household survey. And so we didn't get the best news of all, which would be more people coming into the labor force and more people getting jobs. It was kind of a mixed picture, declined by 18,000, where those unemployed rose by 168,000. So we'll have to figure out kind of what's going on with that, why we didn't see more jobs in the household survey. It diverges from the establishment survey all the time, but that's an interesting fact to pull out immediately.
There's a political issue, obviously, that will be much discussed in both today as well as next month and the month after, and that's the enhanced unemployment benefits. You said that it was too early to really see the ramifications of certain states ending those enhanced benefits early. However, are there any signs in this data as to how that affected things?
No, and there probably wouldn't be, because, Lisa, the survey for this report was taken before any of the states had ended their enhanced unemployment benefits. We do have some data, just the first preliminary data in the jobless claims numbers from yesterday. The first 4 states that saw that took away the enhanced benefits, Alaska, Iowa, Mississippi, and Missouri, they split. Alaska and Iowa saw lower unemployment claims. These are total claims, not initial claims. And Missouri and Mississippi saw a significantly higher level of claims. So it doesn't appear to have any kind of empirical evidence one way or the other yet.
Michael McKee, thank you so much. Greatly appreciate it. And the empirical evidence is markets lifting. SPX says record high right now, 4,323 on the futures, up 12 solid S&P points, Dow up 87 points. And the VIX, a big change there, coming off a 15 level. We enjoy 14.78 right now. Forward, not looking back at the anciently dated, 17 minutes ago, jobs report. Gina Martin-Adams must look forward, Chief U.S. Equity Strategist for Bloomberg Intelligence. Gina, what I see with the earnings filtering in now, this is a look-back earnings, or the earnings to come with J.P. Morgan, is the difficult sport of reassessing the actual earnings we're going to see and those ideas of the look forward. What is the tone that you and your colleagues have gleaned?
Yeah, I think it's going to continue to be more of a look forward than it is second quarter, in particular because second quarter is the easiest comparison quarter. Recall second quarter last year was an absolute devastation for S&P 500 profitability. We had just a scant number of even companies on the index actually recording profit growth a year ago. So we're going to have greater than 50% growth in earnings in the second quarter. The read-through on that is minimal. What companies need to do and what investors are looking for is establish a baseline for where we are going and where we're going into 2022 in particular. As the comps get tougher, as we move into a more normalized environment, where is our steady state of growth? Are we looking at faster growth than we had during the last cycle, which I think the market is starting to warm up to that idea? Or are we going to normalize back at the sort of pre-COVID recession levels?
Well, it's going to be fascinating to see. And of course, it comes up to a phrase I frankly avoid, but right now it works. There is no alternative. Give me the Tina here for Q3. I mean, does it by definition put a bid under the market?
Well, I think as long as the economy is growing, and in particular when the economy is growing at an accelerated pace, there really is no other alternative but to be relatively opportunistic on the equity market. Whether it's U.S. or global stocks, I think is some nuance to discuss. Where you are in the equity market in terms of sector and style exposure is obviously something to discuss in that environment. But the reality is, as long as the economy is accelerating, stocks tend to do very, very well. That's been the environment for the last 12 months. I think what's happening in the equity market right now is we have some confidence that we're going to continue to see economic growth, but we also need to absorb the idea that momentum is slowing. So we're probably at peak inflation right now. We're probably at peak growth. We're probably at peak EPS growth. We're also probably at peak monetary policy support. So we see all of those factors shift somewhat into the next 2, 3, 4 quarters, while generally the conditions will remain supportive for risk. I think that loss of momentum is going to create a little bit of volatility, in particular in sector, factor, and regional market strategy.
There's a question about Goldilocks and this idea that we could have low rates, low inflation, but rapid growth. How long can Goldilocks last for equities?
Yeah, I think it's a really great question because Goldilocks was certainly a huge part of the last cycle story where we had, maybe slower than average growth, but very, very low inflation and low interest rates, which created this incredibly low volatile sort of story that drove the last cycle. And going forward, while we're all talking about whether or not inflation is transitory or not, the signs are pointing to the idea that inflation is going to settle at a faster pace on a secular basis than it was in the last cycle. Will we see growth and a demand recovery really drive that higher pace of inflation? Or will it still be a story of supply constraints? It's a very big question that equity investors are asking themselves going into the next cycle. Because where are we going to settle is a huge question mark. If we're going to settle at faster growth and faster inflation, that commands a very different longer-term equity investment strategy than existed in the 2010 to 2020 cycle, which was really characterized by that low, slow growth, but very, very low inflation environment.
We've heard a lot of investors come on the show and say that they're looking for companies that have pricing power, that can pass along those increases in prices to their consumers. Has that trade already been played out?
I think it's just beginning. Frankly, we've started to see that trade really take fire over the last 2 months. Once we saw inflation peak in May, and then again in June, we saw expectations for the Fed start to shift. company performance has been very closely tied to margin forecasts. What we're seeing on the S&P 500 right now is about a third of companies in the index have recorded a downdraft in margin expectations. Those companies specifically are dramatically underperforming the S&P 500 over the last 2 months, where the companies that are experiencing still an uplift in margin forecasts are outperforming materially. I think this is one of the key characteristics for that stock level, sector level, and style level discussion is where are margins headed and who has pricing power this cycle relative to last cycle, because the companies that are actually experiencing the margin pressure right now are growth companies. They're healthcare and tech companies. That was certainly not the case pre-COVID or even during the peak COVID crisis of 2020. 2021 has already shown some really different characteristics. Will that carry on into 2022 is a question we need to ask ourselves.
Gina, we have Citigroup out today with it's a Citigroup memo to their staff where they're saying, look, you need a pay raise. You need $25,000 a year more right now. Okay, that's the fancy people on the island of Manhattan in 4 zip codes. Does that permeate across America? Are we going to see every industry, every sector say, we're going to give you a pay raise right now because we need to keep you?
I think it's absolutely a risk, and it's the first time we've had this risk in a very long time. We've now had 4 straight months, I believe it is, of average hourly earnings growth. Or at least 4 of the first 6 months of this year, we saw average hourly earnings growth. Earnings growth is growing 3.5%. Wages are accelerating. We do appear to be at this moment in time where labor is starting to gather some degree of power. That also is a key characteristic change relative to the last cycle. If labor continues to command some degree of power, if we start to see wages rise, that is a completely alternative inflationary environment to the one we just came from. We are starting to see also this play into performance in the equity market. Historically, the segments of the equity market that are most exposed to rising labor costs are also starting to underperform. I think it's something to watch. We haven't seen enough momentum in wage growth and real sort of labor power to suggest that things have materially changed. But we are potentially on the verge of that shift, and we need to watch it pretty carefully because this could be a massive shift in the way that we think about margins for the S&P 500.
We had a brilliant essay from your Bloomberg Intelligence today, this from the debt side and Schiffman, and the idea of all that cash out there and sprucing up balance sheets. What are they going to do with use of cash? Are they going to spruce up the balance sheets, as Mr. Schiffman says, of Amazon and others that have all that money? Or is there another trend that you foresee for cash?
Yeah, so I think buybacks are a big part of this story. We think about deployment of capital in a number of ways. You can obviously shore up the balance sheet. You can deploy buybacks. You can increase dividends, or you can spend it in terms of capital spending R&D. I think right now the bulk of the S&P 500 is focused on reestablishing buybacks, which were cut significantly in 2020, and shoring up the balance sheet. So if you're a distressed company, you're shoring up the balance sheet. If you're some of these companies with just exorbitant amount of cash, you're focused on the balance sheet. The rest of the index, however, is starting to think about where do we deploy the capital. Buybacks are the first foray of that capital deployment. Next, in our opinion, is capital spending. I see scope for capital spending to rise 25% over the next 12 to 18 months for the S&P 500, just to catch up with its standard ratio relative to sales. So as long as you're going to see double-digit growth in sales, you're probably going to see CapEx accelerate, which only improves the economic outlook at large.
Just to recap, if you're just joining us now, we did get a better than expected non-farm payrolls report of 850,000 new jobs added versus the expectation for 720,000. An interesting note from Nick Bunker of Indeed.com, the job site, Tom. I was looking and he said that employment is still down about 13% from pre-crisis levels. Strong month of gains, particularly for the leisure and hospitality sector, but still a lot of carnage. And, Tom, I'm struck when we walk down the streets in Manhattan or other places, so many empty storefronts. There are shifts that have been really happening throughout the economy that are persistent. And I wonder how long it will take for those to be worked out. And have we already priced all of those into the stock market and out of the stock market? Have we gotten past the pain that still is very much at the present,
Well,
Tom.
it's a conflation of where we are now with the cyclicals as well, and of course onto structural. Gina Martin-Adams, thank you so much. With Bloomberg Intelligence this morning. She will be with us very much so in this exciting July. As I've said before, it is an earnings season like I truly have never seen. Lisa, I looked at some of the earnings yesterday, some of the retail companies coming out later earnings within the cycle. It's typical to see that before any true earnings season. And, you know, all their forward guidance is it's a boom economy.
Well, the bar is set really high. Can they clear it at an even higher pace? And I'm curious, particularly with the banks, and they're coming out, not the week, but the week after. July 13th, I believe, is the big day for a number of the banks to kick off. How much are they going to indicate demand picking up for loans? How much are they going to indicate more spending on credit cards? How much is the consumer deploying this $2 trillion of cash versus stockpiling it for a better day should they be still out of work? Because there still are more than 7 million Americans not in the labor force.
I mean, I'm looking at the screen, Lisa, before you go away on your 3-week trip, and, you know, I look at it, and it confirms to me that, if anything, we're going to go even tighter on IG and high yield.
Yeah.
Is that possible?
It's possible. I mean, people are talking about the tightest ever in terms of spreads, the least ever in terms of compensation over benchmark rates to own these securities. And not only do you have a credit cycle that isn't near necessarily the end, you also have a Fed put. You have the idea that the Fed could swoop in if there is some sort of market disruption. Again, where do you get yield right now?
Yeah, I don't know where you get yields. What I do know, Lisa, and this is something that the entire team has worked on this through the morning, is when you look, and you mentioned Maine and the lobsters up in Maine, well, they can't compare to what you can see in Greece. Even better, I can't pronounce it. Astracoma carinata.
I nailed it.
It's more down near Thera and some of the islands south of Athens. I think it's more Thera, whatever, but it's like lobster.
I'll bring you a souvenir.
Send me an IG of the lobster. Astacoma.
You're nailing it.
Carinata.
You're nailing it. No, it's good. Look, a lot of people are going on vacation, and that's what you're seeing in this jobs report. How
and
about
an
that
opening of the global economy. And, you know, we make jokes about it, folks, but the symbolism of people starting to travel again as well. Futures up 12, Dow futures up 72. Unambiguously, the tape improves off this jobs report. We will continue consider, I'll say, the nuance of this labor economy. The Secretary of Labor, Martin Walsh, joining John Ferro here in a bit. Please stay with us on radio and television. This is Bloomberg.